there's broad participation in the market, but the magnitude of the upside is just in a handful of names.
It's been a very nuanced move in terms of inequity.
There still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries.
We're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback.
The risks are known, and once the market kind of knows risk, they can deal with it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, one big bill making progress on Capitol Hill.
I felt the Senate was going to be tougher than the House. It's an amazing fact. It's the biggest bill ever passed if we get this done.
I look forward to the House taking up and passing this historic legislation and getting it to the president's desk.
They made it more conservative in some places and moderated it a little bit in others. This is no longer just a House bill. It's not a Senate bill. It's the bill of the people.
A major tax bill might be heading back into some Republican resistance in the House. As President Donald Trump looks committed to deadlines on both taxes and trade, Fed Chair Jay Powell reiterates if it wasn't for the tariffs, they would have cut rates already. The tension builds in Washington.
And it sounds like they're all different issues that are coming to a head at the same time, but it's actually quite similar. It's all coming down to who is going to pay for the increased spending or some of the tax cuts that are not fully funded. Is it going to come from tariffs? Is it going to come from Jay Powell cutting interest rates to 1%? Is it going to come from the growth of an economy that a lot of people aren't projecting out? But ultimately, that is the economic tension that is really the thrust of all of these issues, the bill, the tariff issue, as well as Federal Reserve Chair Jay Powell.
Super tight margins down in Washington, D.C., not just in the Senate, but also in the House. It's the job of Speaker Johnson to herd the cats over the next 24 hours.
It's going to be incredibly challenging to try to get this done by July 4th. Already when you see the outcry from a number of groups, and it's the same groups we've been talking about, these different factions that are vying, those that think the Medicaid cuts go too far, those that think there's not enough spending cuts, and then one or two SALT holdouts that are a little bit concerned about the edits in the Senate. The group to watch is the Freedom Caucus. Treasury Secretary Scott Bessent said last night he had a meeting with them. He sounded optimistic. When you look at some of these lines, Chip Roy, I have very strong concerns. I'm not inclined to support this. Ralph Norman, our bill has been completely changed. This bill is a non-starter. Speaker Johnson can only lose 3.
This is the battle going into the weekend. A week today, there's going to be a battle over trade. July 9th, the President of the United States, I'm not thinking about a pause. I'll be writing letters to a lot of countries,
including Japan, since Japan is evidently the poster child that he'd like to hold up, to beat up, to really show as an example of anybody else.
When did Japan become the new China, the new Europe?
It seems like there always needs to be somebody to be kind of on the whipping post, and right now it's Japan. It's sort of the example maybe to get others on board. I wonder who he's messaging to. Is it the European Union to get on board? Is it India, where negotiations are ongoing? It seems like they just need to hold up some example of badness to sort of get people to comply.
We know this president likes to escalate to de-escalate, take a very maximalist approach. They could be at the final ends of this negotiation, and he's just looking to maximize the concessions out of Japan, maybe when it comes to access to the auto market, when it comes to maybe U.S. rice going into Japan. He says they're spoiled. And why I think this is a negotiating tactic is because he's not even thinking about going back to the 24% initial rate he put on Japan. He's talking about maybe they'll pay 30, 35%. We're going to see, but they haven't been easy to deal with.
Are you going to take some vacation next week? Just take a break from all this.
Maybe. I mean, honestly, this just feels a little bit like kabuki theater. We deal with this all the time. People come out, oh, it's terrible. Oh, my goodness, I'm not going to vote for it. Oh, my God, we're not ever going to have trade again. And then it gets resolved at the last minute, and everybody files into their respective places. And we see that story again and again, and that's where markets are.
Brutal yesterday in markets, wasn't it? Down 1/10%. Oof. On the S&P 500. Snap at a 3-day rally on the S&P. Looking ahead some data later. Look out for ADP at 8:15 Eastern Time. The appetizer before the payrolls report tomorrow morning. Payrolls Thursday's just around the corner. The estimate for this morning is 98K. That's the estimate in our survey. The previous number, a low ball, a big downside surprise, 37. That's coming up later. Coming up this hour, we'll catch up with Brian Nick of NewEdge Wealth with stocks sitting near record highs. Ipsita, Smolinski of Capitol Street as the tax bill heads back to the House, and Wei Li of BlackRock on the mega forces driving global markets. We begin this hour with stocks higher, with President Trump's tariff deadline just a week away. Brian Nick of NewEdge Wealth writing, we called our mid-year outlook the summer of mud. The U.S. economy is getting weaker at an accelerating rate, and we expect downward revisions to GDP growth to resume. Brian joins us now for more. Brian, good morning.
Thanks for having me.
If that's the case, can you still be constructive equities, and why?
It's hard to be. It's hard to be excited about, for us to be about any segment of the market. We're kind of preaching balance. Most of our investors are underweight international. They're still overweight the U.S. dollar. There's still room to, we think, improve kind of risk-adjusted portfolio positioning. But to look at small cap in this environment, which has been a laggard, you really can't get enthusiastic about that if you're expecting downward GDP revisions. To look at the large cap that's run up so fast in valuation, and to look at long-term returns, which is what our clients tend to be interested in, and say, what do you really hope to get from an upside here with 22 times earnings, 36, 37 times Schiller PE? It doesn't look like an appetizing time. And then you have to look at the other side of the ledger, the bond market. You really have to go into this with your eyes wide open with the debt situation coming up and the potential that the Fed cutting interest rates at the short end may not do much to cause bonds to rally.
Let's stay on equities first and throw a sector in there. Bank stocks, KPW Bank Index close to all-time highs. Big buybacks. Wells Fargo, Mike Mayo coming out and saying, so long as we avoid recession, it's game on for bank stocks. Is just avoiding recession good enough? Even in a decelerating growth environment, is avoiding recession good enough?
I think if you get some steepening in the yield curve, that's going to help a lot of these stocks too. If you get some benign Fed rate cuts, now we don't think that's all that likely. We think what the Fed's got priced in right now is probably not right. It's either going to be no rate cuts because inflation just comes back in a way that doesn't allow them to move, or it's going to be more like the equivalent of 5 or 6 rate cuts. But if you do get sort of a benign steepening in the yield curve, that can help bank stocks. That probably also means we're not in recession. It probably means we're in more like a 1 to 1.5% GDP world. And we know from history that the stock market can grind higher in that type of environment, even from here, but it's going to be mostly the earnings. So it's going to be, fits and starts inching your way back up, not big lurches like we saw in May and June.
One of the most interesting things is how diametrically opposed different notes are about whether we're going to see upside surprises or downside surprises to the U.S. economy in the next few months. Some people say that the bill that is just being passed in Washington, D.C. will act as a stimulant. I know that you have disagreements with that, Annmarie, but in particular, you've got deregulation and you have the expansion of the deficit on the behest, frankly, of corporate profits. Why is that not enough for you?
I think it's going to help in the near term because a lot of the things that are sort of cost savings in the bill don't actually go into effect for a few years. So it's more stimulative. If you look at the CBO, you look at independent Wharton put out an analysis about this yesterday. It is stimulative in the near term. The question is stimulative into what kind of environment? Retroactive sort of business tax cuts, business tax incentives are going to help earnings this year. Is going to help earnings next year. But if we're at a situation where, like we've seen consumer spending negative for the first 5 months of the year, housing prices declining, people becoming less constructive about the labor market, how much of an oomph are we going to get? How much more businesses going to hire and invest with tariff-based uncertainty still, and with a lot of concerns about the economy, independent of what passes in this Congress?
Meanwhile, you talk about the yield curve steepening and what could happen in the bond market. If I were a cynic, I would say every time people didn't understand the bond market, they started to talk about bond vigilantes coming back. There is a sort of theory of the mystery of the bond vigilante who may or may not come back to protest a bill, where they don't seem to be anywhere in sight right now. So how do you square that?
What you're seeing, two things happening at the same time. One, the economic data is getting steadily worse. And two, there's this big budget-busting bill that's about to pass. It's even going to be more deficit increasing than the one that passed the House. And if you assume a lot of these trap doors don't get sprung, where we don't actually see things sunset in 2029, we don't actually see, some of these senators don't seem to think the Medicare cuts or Medicaid cuts are going to happen in 2027. If those things don't happen, this bill is even larger. So if you're walking into the bond market right now, you have to do it with open eyes. You have to think short term, I'm going to see enough of a weakening in growth to get the 10-year down to 4.20, maybe down to 4% or below. But that's not going to happen absent a more significant downturn. You're likely to just be clipping your coupons here, if that. And I don't think you're going to see a further rally in the bond market unless the economic data weakens more.
For the record, I do think it's stimulative, but on the margins. This isn't like 2017. The crux of this is extending policy. What it does offer, though, is clarity. Because it's clarity that policy is not going to sunset at the end of the year. Doesn't that get you excited? When everyone's talking about all this uncertainty?
The most expensive parts of the bill are just maintaining the status quo, right? So that's not going to be overly stimulative. Somebody whose tax rate was 19%, if that stays 19%, that's not going to stimulate them to do more. And frankly, most people probably don't appreciate that by the end of the year, if nothing gets done, the tax rates are going to go back up. So I don't see it as stimulative, but some of the new business measures, making those permanent, making expensing permanent, that should help. And for some business pass-throughs, like individuals that are taxed like businesses, this is going to give them more incentive to expand those businesses as well. But I agree with you. This is not a huge stimulus bill like the ones that we've seen passed in the last couple of years. This is maintaining the status quo for most of the tax code and doing some spending increases in the very near term and hoping for spending cuts down the road.
As we seek for clarity, would you want to be maybe excited about July 9th then? If the president is saying everyone's getting a letter, I'm not doing any extensions, because at least you'll have clarity and not all the whipsaw of headlines?
Unlike the expiration of the tax bill from 2017, there's no statutory deadline here. This is just arbitrary. And we've seen these deadlines come and go in the past, sometimes with things like TikTok, but also more recently with trade, 30-day extensions on the Mexico-Canada agreements. We're like 90 days into that 30-day extension. So I don't think anything's magical is going to happen necessarily on July 9th. There may be some letters that go out, but the idea that we're going to see all these tariff rates go back up to where the announcement was on April 2nd, I think if people are expecting that, A, it's not incorporated in the markets, so the markets aren't thinking that's going to happen. I think that's a reasonable assumption at this point.
Brian Nick of NewEdge Wealth. Brian, thank you, sir.
Thank you.
Getting excited about clarity in the second half to replace all the uncertainty of the last several months.
Look, we need some excitement. I mean, we've had a lot of excitement, don't get me wrong, in the first 6 months.
Right now, won't you?
Sure. Well, boring is great, but if you can get excited about something that has some stability or staying power, I think that we all would be excited for that. So, predictability is a good thing.
Take a few summer months. That's what we need right now. A few summer Wednesdays,
Yes.
just really quiet mornings when nothing happens.
Isn't this what the Fed is asking for? Is this what Jay Powell is saying? We could have maybe cut rates if I knew what the tariff rates were, if we had some clarity. This should be mood music to the ears of the president.
We've been asking guests over the last week or so, what would you take? Extend and pretend, just keep this going on for the next several years, or just say 10% and move on? And a lot of people have just turned around and said, you know what, I'd take 10%, move on. Just move on with the whole thing.
What do corporate executives do when they think about how to arrange their supply chains if they're dealing with a policy that is so ambiguous, that's like holding water? And the answer is it freezes them, and frozen policy is policy, and that, I think, is causing a lot of anxiety.
Will we actually get a resolution a week today or a repeat of April 2nd? It's a week away. Equity futures right now in the S&P slightly positive by 0.1% with an update on stories elsewhere. With your Bloomberg brief this morning, here's Yahara Arnott. Hey, Yahara.
Good morning, John. President Trump's tax and spending bill is back in the House after narrowly passing the Senate with a tie-breaking vote from Vice President J.D. Vance. It's running into resistance from Republicans who don't like some of the changes. Moderates are worried about Medicaid cuts, and ultra-conservatives vow to oppose it over its impact on the deficit. Meanwhile, as you just said, we're just 1 week away from President Trump's self-imposed July 9th tariff deadline. Beyond that date, countries that did not strike deals with the U.S. will see higher tariff rates. The president says he's not considering any delays, and he's renewing his threat to cut off talks and impose higher rates on several nations, including Japan. And Tesla is expected to report another downbeat quarter, with analysts forecasting a 12% drop in sales from a year ago. That would follow a 13% decline in the first quarter. Meanwhile, Tesla shares are off to a rough start this quarter, which just started, as Elon Musk renewed his feud with President Trump over the massive tax and spending bill. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, we're at the 1 yard line.
85 to 90% of this bill is the House-generated product. The Senate made some modifications to it. We're at the 1 yard line in this game that we're going to run it right up the middle and score for the American people.
That conversation up next with Ipsita, Smolinski of Capitol Street, live from New York City. You're watching Bloomberg TV. Live from New York City this morning. Good morning. Welcome to the program. If you're just waking up, good morning to you all. Equity futures positive by about 0.1%, bouncing back from losses yesterday of about 0.1%. On the Nasdaq 100 this morning, positive also, and snapping back on the Russell, the small caps up by 0.9%. Under surveillance this morning, we're at the 1 yard line.
85 to 90% of this bill is the House-generated product. The Senate made some modifications to it. They made it more conservative in some places and moderated it a little bit in others. This is no longer just a House bill. It's not a Senate bill. It's the bill of the people, of the hardworking American people, and we are going to deliver it, as you said, Sean, by July 4th. We're at the 1 yard line in this game that we're going to run it right up the middle and score for the American people.
It's the latest this morning. The big, beautiful bill hitting some resistance in the House as lawmakers return to Washington to vote on the Senate's version of the legislation. Joining us now from Washington is Bloomberg's Tyler Kendall. Now, Tyler, Speaker of the House, Mike Johnson, making this sound quite straightforward. I imagine this is not going to be straightforward through the next 24 hours.
Yeah, hey, John, good morning. This is by no means a done deal, though we are only expecting President Trump to ramp up the pressure from here, which does hold a lot of weight in Washington. We have to keep in mind that this House bill was designed not to ping pong between the two chambers, which means that if House members do want to make changes, they're likely going to have to call what's known as a conference committee on the procedural level, which means the Senate would have to get involved. That's sort of the wonky way of saying that if they do want changes, it's going to take time, and that could ultimately jeopardize that July 4th timeline. Now, we're running into the same issue in the House that we just saw play out in the Senate, which is that mainly Republicans are on board with the tax cut policy in this plan, but they're pretty divided over the spending cuts. And House Speaker Mike Johnson can really only afford to lose 3 Republicans, and he already lost 2 back in May. Thomas Massie of Kentucky and Warren Davidson of Ohio, and we're not expecting either of them to budge on their no vote, which means he can only afford to lose 1 more in addition in order for this to pass. Now, perhaps the most vocal group emerging at the moment is the House Freedom Caucus, who are accusing the Senate of not living up to its agreement for deeper spending cuts by a tune of $500 billion. But I would also keep our eyes on some of those moderate Republicans in some important battleground districts who have raised concerns about the changes to Medicaid. Not necessarily tightening the work requirements, but lowering the Medicaid provider tax, which would essentially mean less federal matching funds for these states that expanded coverage under the Affordable Care Act. In fact, John, 16 of these Republicans signed a letter last week saying that they would not support the bill if it lowered this provider tax. And at this point, we're waiting to see if they're willing to defy President Trump.
Tyler Kendall with the latest down in Washington. More from Tyler in the next hour. What are the odds that we're just going to play ping pong between the House and the Senate for a little while?
I mean, high at this moment, unless they're able to get everyone across the line -3. But likely this can go to conference and at least a week that they'll go through this process of trying to get to one finish line where they both could agree on.
Let's build on that conversation. Ipsita Smolinski of Capitol Street joins us now for more. Ipsita, welcome to the programme. I just want to bring you the president's quote. We can have all of this right now, but only if the House GOP unites, ignores its occasional grandstanders, you know who you are. How many so-called grandstanders are there? How difficult is this going to be?
You know, look, and first of all, good morning. Thank you for having me. We have gotten so far. You know, Tyler summed it up really well. We had the House bill ping-ponged over to the Senate bill. What happened in the Senate is that a lot of those tax extensions became permanent. So guess what? The bill got more expensive. And so you had to look for more spending cuts. Medicaid is what took the hit. And of course has been extremely controversial just after, you know, the last 24, 48 hours. Really, it's been Medicaid and a few other odds and ends for sure. So now here we are. The House looks to convene this morning, right, after a marathon rules committee. And I think if all went well, we could see a bill that's passed today. I don't at all rule out what Annmarie was saying earlier about a conference committee. You know, it might be a more informal conference committee, not the one that we have seen over the last 10 or 20 years where there's actual appointed members and so on and so forth, but more of an informal conference committee among leadership to kind of iron out the details and get it across the finish line.
When you say Medicaid has been hit, what was the biggest blow to the program?
Sure. So I would point to 3 or 4. I would say the Medicaid work requirements saves about $300 billion over 10 years. And that's this requirement that folks in Medicaid, now these are able-bodied adults. These are not pregnant mothers or babies under 1, of course, folks who are going to be required for 80 hours a month to look for job, volunteer work, even schooling counts. It's a pretty light work requirement. However, what we've seen in states that have tried this experiment is that employment doesn't really get boosted, and instead there's a huge paperwork burden where folks can't upload their forms and all of the different verifications. It's almost like filing your tax returns once a month. So people do lose coverage. So that's a biggie. The provider tax is another issue where it's perfectly legal. Medicaid is not a great payer, but what will happen is states will levy a tax on, say, a hospital or a psychiatric facility. maybe that's $100. Then they turn to CMS in Baltimore and get that matched rate of $100, maybe more. And then that payment goes back to that hospital through the managed care plan or the MCO. Those are companies like Centene, Molina, United Health, Aetna. Those are the plans that play in the Medicaid space. The point being is that has been gamed to the point where that percentage will get taken down from 6% to about 3.5%, going down 50 basis points a year, starting in 2028. Some of these provisions do start in the out years, so there is certainly time to modify them, but that generates a couple $100 billion over 10. The last, I would say, big impact to Medicaid is the state-directed payment program, where states, all kinds of states, red states, blue states, have come to agreements with the Medicare program, CMS, here in Baltimore to have elevated rates. They're not Medicaid. They could be closer to Medicare or commercial rates in order to finance their programs, essentially. And a lot of those are non-expansion states. So remember, 9 or 10 states have not expanded their Medicaid program.
Given that tax rate doesn't start until 2028, will that assuage some of these concerns of those 16 Republicans Tyler was just mentioning that signed up to this letter saying they're not going to support this if they see that tax rate?
I think they could. I think we could hear a lot of discussion today, maybe tomorrow, about commissions and ways to maybe do another reconciliation bill or ways to kind of amend what's being done here in order to lock in the votes. I mean, I will say that House Republicans do have a good track record of sort of coming in line where the president wants to be to get things done. And let's not let the perfect be the enemy of the good. Ipsita, how much are we seeing a precedent getting set where essentially the holdouts in the middle get bribed to get on board? Essentially, they can get handouts for their states and they'll get on board at the expense potentially of the deficit or at the expense of certain programs that might not be great for the rest of the country, but they got their share. Well, right. And nobody can ignore the 3 or 3.3 trillion in deficit. The CBO is coming out with new numbers, I think even new ones as I was coming here today to your studio. Huge losses in membership for Medicaid, for even exchange folks. These are the Obamacare exchanges, less noticed in the bill, but some pretty big impacts there as well. Medicare was not touched in the bill. I wanted to mention that briefly. The president said that he would not touch the Medicare program. Medicare Advantage plans, again, United, Aetna, CVS, others are plans that operate in that market. There are some perceived, I would say, upcoding and waste, fraud, and abuse that could have been addressed. Again, that was not in this bill. PBMs also, those are the middleman. They are very vilified, I would say, here in D.C. on a bipartisan basis. Well, there were some reforms. They might have been more milquetoast reforms, but those also fell out of the bill due to the parliamentarian process just recently over the last few days.
Ipsita, I'm pleased you've read the bill. At least there's someone out there that has. Thanks for being with us. Ipsita Smolinski there of Capitol Street. What was it, 940 pages?
It's something insane. I mean, honestly, how many people are actually getting through the whole thing? But in some of those pages, they are specifically put in there for specific Congress members to get on board, and that is exactly how this process went down.
Bond investors have been ignoring it as well over the last few weeks. Yield to higher this morning by 4 or 5 basis points at the very long end of the curve. We'll keep tracking that story. Also want to track the latest with the labour market with payrolls tomorrow, the ADP report later. We need to talk about AI. In the Journal yesterday, if you missed this story, let me read some of it to you. Bank of New York Mellon said it now employs dozens of artificial intelligence-powered digital employees that have company logins and work alongside its human staff.
Yeah, this has been a huge issue, particularly for entry-level workers, because you've seen, for example, college grad, the hiring rate just fall off a cliff. How much are we going to see the workforce transformed in a way where everyone doesn't get a job, but the transformation is stark and leaves a number of people out?
Up next on the programme, Cisco Chief Product Officer Jeetu Patel on how AI is reshaping the labour market. Then later with Danny Berger, we'll go through your morning movers. Centene plunging after withdrawing guidance. Equities positive right now by 0.1% after snapping a 3-day winning streak on the S&P in yesterday's session with some very mild marginal losses. On the Nasdaq, we snapped a longer winning streak than that on the Nasdaq 100. We were looking at gains for 6 consecutive days until yesterday. This morning, just about unchanged. Plenty of movers out there, including one big one with 3 hours until the opening bell. With your morning movers, here's Danny Berger. Hey, Danny.
Yeah, John, a huge one from Centene, to the point where if you didn't know this company, you'd assume it is something of a penny stock, down 27%. But this is a $30 billion market cap health insurer. They withdrew their guidance for this year. At issue for them, they said they did channel checks with 22 different states, and it does appear that the compensation that they usually get for taking on sicker patients is less than they expected. That could mean a revenue hit of something like $1.8 billion. And if this sticks, this price would be their lowest since 2017. We're also seeing other health insurers decline in the pre-market session this morning. Elsewhere, a nice little pop from Spotify this morning, up just about 1%, or exactly 1%. About an hour ago, the Journal publishing a story, according to sources, Netflix looking at expanding some of their live events like concerts, different music competitions, and it's considering, or at least held talks with Spotify for those type of events. Finally, rounding things up with some sell-side action this morning, Crocs getting an initiation from Goldman Sachs, setting it at a price target street low of $88. They say that, yes, they have good advertising, interesting different products from Crocs, but competition is stepping up and demand is normalizing. I have no idea what competition for Crocs is. I don't know what other shoe looks like them, but regardless, shares down 1.5%, John.
I think collectively we've had a sell rating on that trend for quite a while.
Oh,
Danny, thank you.
I think
Danny
they can
Berger
be.
with the latest.
I think they can be useful.
Are you a Crocs kind of person?
I don't know if I'm a Crocs kind of person, but if you're going to a pool and you have kids and
they're
put on
acceptable
their
for
little...
children.
Oh, is that right?
That's it.
What about snowfers? Have you heard about snowfers?
What are snowfers?
That's a sneaker loafer. That's the new trend. It's a snowfer. That's taking over Crocs.
Oh, Prada has them. No, they do. They're gross.
Right.
It's a loafer with like a sneaker sole.
Yeah.
Or something like that.
Yeah, snowfers.
And I'm still against the dudes that wear sneakers with suits.
Yeah, I know.
You know, the guys.
I know you are.
With the black shoe with the white sole.
You should just try a Croc.
You see them walking around the Senate.
Just try a
I'm not trying a Croc. That is never happening.
Green.
On our radar this morning, President Trump's tax bill heading back to the House after narrowly passing in the Senate. Lawmakers set to vote later today, with a number of Republicans remaining opposed to the bill, and Speaker Johnson only able to lose 3 votes.
He can only lose 3 votes, and then when the bill passed in the House earlier in May, only passed with a 1-vote margin. So he's really dealing with really tight margins here. And the group he needs to look out for is the Freedom Caucus. They have been very vocal, and they do not like the bill that has been edited in the Senate. And they're basically saying, for us, this is a non-starter. So there's going to be a lot of backroom dealings. You hit on this point earlier. What does each individual want to get? A lot of pork is going to have to go around to get individuals to sign up and say yes on this bill.
Well, Lisa Murkowski of Alaska is the perfect example. She voted for this bill. She was the swing vote. And what they had to do to get her on board was enormous for the people of Alaska. If you're in Alaska, you can thank Lisa Murkowski. For the rest of the country, I don't know. Even she is coming out and saying good things are important, but it also is important in terms of how they are paid for. And I struggled mightily with the impact on the most vulnerable in this country when you look at the Medicaid and the SNAP provisions. Basically, she doesn't like what it does to the rest of the country, but Alaska got its due, so okay.
When the president says ignore the occasional grandstanders, everything you've just said, isn't that fuel for the grandstanders to come out and say, you know what, I'll have some of that?
Yes, exactly. And when you look at the Senate version of the bill, she took it to extreme lengths because she really was the last holdout and they really needed her votes. But if you look at everyone got something. Ted Cruz got more money when it comes to the border. Everyone got a piece of pork, as Steve Dennis would say. But what's so interesting about Lisa Murkowski is she said, do I like this bill? No, she wants the House to vote it down so it goes into conference so they can work on it. If you don't like it and you want it to go to conference, then why'd you vote yes?
We're dancing around 2 self-imposed deadlines. One is for taxes, that's July 4th. The other's for trade, a week today. The president saying he has no plans to push back the tariff deadline, set to take effect just a week away. The White House signaling trade deals will soon be announced with only 2 countries signing agreements so far.
Yeah, and it's the UK and China, of all places, even though that was supposed to be the hardest. Meanwhile, you've got Japan that's potentially on the chopping block. You've been chopped from the potential actual negotiation. We're just going to send you a letter. India has been extending their discussion with the United States. There are these hairy discussions at the same time that President Trump is coming out and saying, I'm not going to extend the deadline. Forget it. So it raises the question, I don't want to say taco because that's not the case. It's more how much is this really ultimately somebody who wants to negotiate and ratchets up the pressure as much as you can to get as much as you can.
Anchors to the extreme, a week away. I'm not going to let it slide, and we'll see what happens a week today. I wanted to squeeze the banks in. We've seen a massive rally. Wall Street's biggest banks announcing fresh plans for stock buybacks and dividends after passing the Federal Reserve's annual stress test. The Fed finding all 22 banks examined would hold enough capital to withstand an economic downturn. These names are up again in the pre-market. I can tell you the KBW Bank Index is higher for 9 consecutive sessions.
And yesterday, after this stress test result came out, you saw every single one of these banks announce a dividend increase, plus share buybacks authorized by J.P. Morgan. It raises a question for July 15th when J.P. Morgan kicks off bank earnings. How much do they increase risk as a result of deregulation? How much do they increase their expected payouts? How much do they try to seem like growth stocks again after so many years of being tethered by regulation?
Should we talk about how we're all being replaced?
I think
Should we start that conversation?
Why don't I have my bot do it? ChatGPT. Lisa, ChatGPT, what do you think? I think it's great.
Let's do that right now. Turning to AI. That was nice. I imagine it'll be a little bit more realistic than that. Cisco's president and chief product officer, Jeetu Patel, saying we're on the verge of a second major inflection in the development, writing AI agents will produce original insights and help us solve problems that we might never have dreamed of solving before. In this sense, I think agentic AI is the single most important technology leap of our lifetime so far. Jeetu joins us now for more from Cisco, and he's quickly becoming our AI therapist. Jeetu, welcome back to the program, sir. That last line is pretty strong, Jeetu. Bigger than the internet? Bigger than that big?
You know, each one of these technologies, firstly, Jonathan, thank you for having me. I am sorry I couldn't be there in person. I'm in these beautiful London Bloomberg offices. So let me just say, if we take a step back, we are in the second major phase of AI, where we used to be the past 2.5 years, what we've experienced is chatbots intelligently answering questions for us. We're now squarely in the second phase, where agents will be able to conduct tasks and jobs almost fully autonomously on behalf of humans. And it's going to completely unlock potential that we haven't seen before. And I'm pretty excited about the potential of what this is going to be able to do to solve problems that we have not been able to tackle as of yet. That's probably the most underhyped part of AI, in my opinion.
Well, let's get into that. That phrase, unlock potential. Yeah. I'm thinking about unlocking potential for who? People who own the stocks, people who run the companies, or people who actually work at the companies and run the operations? The difference between, say, job replacement and job enhancement, Jeetu. What's the difference between the two?
You know, so the way I think about it is there's a definitive pattern in history of the way that technologies get adopted. The first phase is when people are fearful of the technology, and then they flourish with them. And we are currently in this mode of largely being skeptical of AI, thinking it's going to take our jobs. And like I said to you the last time I saw you, Jonathan, I worry less about AI taking my job. I worry about someone using AI better than me that's probably going to take my job. And we should make sure that we democratize the use of AI for every person so that we can actually unleash our potential. And that, in my mind, is an area that we don't talk enough about right now, which is what are the unsolved problems that we have not been able to solve because of original insights of AI that we'll be able to solve today. Think about the kind of new businesses that people will be able to start, the kind of diseases we'll be able to solve for. Now, I'm not delusional. It's not that this comes without any risk. Security and safety is a huge risk. We ought to make sure that we actually get all over that and band together as a community to make sure that we can solve those risks. But I'm a net optimist of AI rather than thinking that it's going to take every job that's available for humans right now.
Jeetu, that's a pretty extreme prediction. There is this question of who potentially benefits within the labor market and who is left behind. And I wonder, at Cisco, you talk to a lot of companies. How are they preparing their workforces, and are they aware of how much retraining is necessary to keep their humans relevant?
Yeah, I think there's, most organizations right now are thinking about how is each job going to get reconfigured, and what are we going to need to do to make sure that the augmentation of AI to a human makes the human more productive. What we want to do ultimately is make sure that AI can reach its full potential. Humans can reach their full potential with AI. So, for example, at Cisco, we are hoping that there's going to be a lot of code that gets written autonomously. That doesn't mean that we're going to have less engineers. That means that the engineers will provide more insight, more oversight, and they'll actually think about new ideas because we are currently so constrained with engineering talent that we're not able to prosecute all the ideas that we have, and now we'll be able to actually get more throughput capacity as a result of having AI being a companion for every engineer. And so I feel like every single job will need to get reconfigured slightly, will need to have be adjusted, but this is no different from any other previous technological revolution that we've had. With the internet, you had to have the same. With the personal computer, there was the same kind of reconfiguration of jobs. And yes, some of those jobs will go away, and there'll need to be some retraining. But frankly, there'll be new jobs that emerge that we haven't seen up until now that allow us to actually move even faster.
One of the issues and one of the differences now versus the internet or the industrialization or even the engine when it came out is the speed of how quickly this is getting implemented, of how quickly the development is going. And we're getting to phase 2 before some people even understand the potential of phase 1. And by the time we get to phase 3, there are going to be a whole host of people that don't even realize how behind they are. Just how big is that mismatch in terms of the speed of the evolution and how behind a lot of the workforce is to meet it?
This is actually a really important point, Lisa, because the speed of the pace of change is something that we've never seen before. And frankly, that's why sitting on the sidelines and waiting for this thing to kind of play out before you jump in is exactly the wrong strategy. What we need to do is make sure that everyone's actually getting dexterous with the use of AI, because there's only two kinds of companies in my mind, those that are going to be extremely dexterous with the use of AI and others that will actually really struggle for relevance. And we want to make sure that there's more and more companies that are in the first category, not the second. And so I do feel like speed's an important dimension. And in order to tackle that, every company just needs to make sure that they're actually thinking about getting in, not sitting on the sidelines, but immersing themselves and experimenting with AI as quickly as possible so that they can get an instinct, they can get some kind of judgment of what this is going to look like over time.
Jeetu, you're not just working with companies, you're also working with governments. Front page of the Wall Street Journal today is talking about how China's AI companies are basically challenging U.S. superiority. Who is doing it well? Who do you think is winning this race?
Well, I think right now, while U.S. is in the lead, China is actually catching up fast. And so we need to make sure that we continue the pace of innovation that's there. And what you want to see is that the U.S. companies are becoming some of the standards for infrastructure build-out that might be all around the world, for safety and security all around the world. You want to make sure that that happens. And that's why it's so important that the companies that win and the countries that win with the AI race are the ones that are also going to win economically. They're also going to win from a national security standpoint. So there's a lot of benefit to making sure that you're kind of immersing yourselves in an AI. I was recently in the Middle East, Lisa, and we announced some partnerships with the Saudi government and with the Kingdom of Saudi Arabia, as well as with the United Arab Emirates, where we're going to help with data center build-outs. And if you think about what the constraints of AI are, there are three things. There's power, there's compute, and there's networking capacity. Those are the constraints. And we need to make sure that this infrastructure gets modernized and that we have American companies that are helping in participating in these massive data center build-outs, which actually provide the infrastructure necessary for everyone to be able to have access to AI.
Jeetu, just before you go, we're focused on payrolls this week. Lisa's been doing a great job over the last week or so, just bringing up, highlighting continuously, repeatedly, how difficult it is for graduates to get a role at the moment. And I just wonder how this is going to impact hiring at the entry level over the next several years or so. As companies figure this out, they'll invest a lot in software, invest in the current staff to learn how to use some of these things. But I'm not sure they're going to hire at the same pace, Jeetu. And I wonder what your experience is now, both within Cisco and looking out, speaking to other companies.
John, you and I talked about this last time as well. I actually tend to learn so much from the people that are AI natives that are just coming out of the educational system, because they think they use AI very differently than folks that have been around for a while. And so I actually don't think it's a good strategy to not hire entry-level candidates and just think that AI is going to replace those jobs. Frankly, I feel that you have an entry-level candidate with AI as a companion, you can start to see meaningful levels of compounding of value And so I do feel like there's two categories of people that are actually doing really well with AI. The early entrants who've actually been AI native, that know and have a very different instinct for how to use AI. And then the second ones are the highly experienced group of people that are using it well. What we need to do is we need to make sure that we train the people in the middle so that they're all not fearful of AI, but they're in fact starting to think about this as an accelerant to their personal productivity as well as the productivity of the companies.
You're slowly converting me, Jeetu. It's wonderful to catch up. Enjoy London, sir.
I'm so glad, Jonathan.
We'll see you in New York soon. Jeetu Patel there of Cisco. Thank you, sir. He's wonderful when he breaks all this stuff down. I think a lot of people still fearful.
Yeah, if you're not an AI native, I think about AI natives versus someone like myself who's kind of right off the boat trying to figure it all out. But I do wonder, what this really does to the dynamic of a labor market and how you factor that into some of the payrolls figures that we're seeing. I mean, what's a good job at a time where the job description is changing so dramatically?
So true. We'll look at those job numbers a little bit later this morning and again tomorrow with an update on stories elsewhere with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. President Trump says Israel has agreed to conditions for a 60-day ceasefire in Gaza. In a post on Truth Social, Trump said mediators will now deliver the proposal to Hamas and warned them the deal will not get better, only worse. Israeli Prime Minister Benjamin Netanyahu is set to visit the White House on Monday. Meanwhile, Columbia University was the victim of a hack. A Bloomberg investigation revealed that 2.5 million students and applicants' information were stolen. We reviewed data provided by a person who claimed to have hacked the school back in June. It included university-issued ID numbers, citizenship status, and application decisions. The data stolen dates back decades. And season 3 of Squid Game shattered records, drawing over 60 million views in just 3 days. The final season of the Korean dystopian thriller also hit #1 on Netflix in 93 countries. Netflix says 80% of its members have watched Korean content since Squid Game debuted in 2021. That is not me. That's your Bloomberg Brief. John?
It's not me either. Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes. Up next on the programme, 1 week and counting.
Mr. President, are you thinking of extending the pause on tariffs and bonds like that? No, I'm not. I'm not thinking about the pause. I'll be writing letters to a lot of countries, and I think you're just starting to understand the process.
Up next on the programme, Wei Li of BlackRock. Live from New York City, welcome back to the programme. Under surveillance this morning, 1 week and counting.
Mr. President, are you thinking of extending the pause on tariffs and bonds like that? No, I'm not. I'm not thinking about the pause. I'll be writing letters to a lot of countries, and I think you're just starting to understand the process. We've dealt with Japan. I'm not sure we're going to make a deal. I doubt it. They and others are so spoiled from having ripped us off for 30, 40 years that it's really hard for them to make a deal.
It's the latest this morning. President Trump threatening Japan with tariffs up to 35% while doubling down on his self-imposed July 9th deadline for trade talks. Wei Li of BlackRock writes, in a world of weak macro anchors, mega forces like artificial intelligence are the new long-term anchor for achieving durable returns. Wei joins us now for more. Wei, good morning.
Good morning.
Is it getting harder to find a long-term macro anchor in this environment?
Well, long-term macro anchors have been lost. You look at inflation anchors, you look at long-term growth anchors, you look at long-term fiscal anchors, you look at even anchors in institution confidence, right? Like the safe haven status of the dollar, but maybe also independence of the Fed. So it's really hard to find long-term macro anchor, which is why we actually think that it's easier to think about tactical asset allocation because of immutable laws around U.S. debt and global supply chain. Paradoxically, there is greater certainty in our assessment in the near term than in the long term, which is the opposite of what has been always the case, which is why we're moving risk targets in terms of the budget deployment from longer-term strategic asset allocation towards tactical asset allocation. This is one of the best tactical investment environments.
So what's the tactical approach currently for you and the team?
Right now, we are investing for the here and now, which is to recognize that so far this year, we have focused a lot on tariffs, and we're still focusing on tariffs, which is very different from Trump term one, where we had tax cuts first, and then we had tariffs. But now focus is going to shift also towards tax cuts, also towards deregulation, potentially unleashing animal spirit. And yes, tariffs headlines are still flying around, but we do think that because of the constraints and immutable laws that I just talked about, we're going to get to some sort of landing spot, not likely derailing the tactical kind of risk-on view that we still have. So right now we still like U.S. equities, and I would observe that at this juncture is no longer consensus. I speak to investors across the world, Europe, APAC. I would think that it's more divisive right now, but we still like it. The condition for sustained rest of the world, Europe outperformance over U.S. haven't been met, which is why we haven't chased the European equity outperformance beyond closing the underweight to neutral earlier in the year.
So you keep mentioning the immutable economic laws, and I think this is a really important point. And in the outlook that BlackRock put out, you did write, we think immutable economic laws will prevent a return to a maximal stance. How much does this just mean fade the extremes, fade the tail risks, because they always will come back to the center based on math?
That's exactly right. If we faded extremes, which we did, think about kind of how we up-risked immediately after April the 9th, then we would have captured, and we have the 20%, more than 20% rally from the April trough. So it's really recognizing that even though headlines can be very scary sometimes for markets, there are things governing how quickly things can change from status quo in the very near term. So if we want to close trade deficit, then we lose a lot of the reliance on foreign funding. And given that the U.S. has the highest financing needs among G7 in terms of percentage of GDP and one of the shortest average debt maturity, that is something that cannot really be messed around with, which is why we believe, especially at times of a huge amount of uncertainty in market narratives, this strategy is rewarding and in fact has worked really well this year.
Just quickly, how fragile does that make this market that has become numb to extremes?
I think markets are not yet numb to extremes in that you still see headlines like whipsawing day-to-day market volatility. We see equity sensitivity to incoming data at a much more elevated level compared to pre-pandemic. We see rate sensitivity to incoming data, like we're talking about month-to-month inflation print, but the long-term 10-year sensitivity to month-to-month inflation prints is so much more elevated now, which means that markets are trying to extrapolate from incoming data what it means for the long term, which speaks to the loss of long-term macro anchor, which is why if we have a very clear kind of assessment of the fundamental picture that allow us to play the current environment tactically and reversal strategies in the middle of wildly swinging market narratives has been very rewarding for our active platform.
Super thoughtful stuff. Wei-Li, appreciate your time as always. Thanks for being with us here in New York. Wei-Li there of BlackRock. We do get more data a little bit later, the ADP employment report in about an hour and 20 minutes. The estimate in our survey so far, 98,000. Last time around, a big downside surprise, 37K. We'll see what we get a little bit later this morning. Up next, we'll catch up with Sarah Hunt of Alpine Saxon. Words later in the hour, the former Speaker of the House, Kevin McCarthy, Matt Luzzetti of Deutsche Bank, and Joe Lavorgna, the counsellor to the Treasury Secretary, Scott Bessent. From New York City, this is Bloomberg.
It's a very interesting dynamic for the U.S. economy right now. The labor market has loosened a lot.
The labor market's still holding up.
The whole narrative of the economy having avoided a recession is a reasonably positive backdrop.
You've seen economic surprises turn much lower. People have been cutting their GDP growth estimates.
Liberation Day is really what drove those U.S. growth expectations lower. And part of that also fed into people selling dollar assets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P positive by 0.1%, snapping back, bouncing back from some mild losses in yesterday's session. On the Nasdaq 100, down not even 0.1%, negative 0.05%. Things could get more interesting as the day progresses when we get some economic data. 8:15 Eastern Time, the ADP employment report. Later in the week, of course, about 25 hours away, the jobs report in the United States. That's just around the corner. Then through the weekend, looking to see if the president gets his bill.
And this really is going to be key because the more certainty we get about the bill, what that looks like, what the deficit will be, and then the tariffs and what that deal will be when we get that in about a week, then we can get a sense of what the economic ramifications could be as we extrapolate out and try to understand the new normal that we're in, that everyone has become benumbed to. And that is what people are hoping for. Will they get it? I think still remains a question.
Jim Caron and Morgan Stanley joining us later in the program in the next hour. Jim making the point that he thinks in the second half of this year, you'll see clarity replacing uncertainty. And I think looking down to D.C., that's a hope we all share.
That's a hope that also you see projected right now when it comes to what's going on in the House. There is, from the leadership of the House, trying to project this clarity that they can get the vote today. They're going to reconvene at 9 o'clock. Potentially, we could see a vote as soon as today. Yesterday, it was 8 individuals we were worried about. It's about the same, maybe even 12, a handful. But everyone has different issues. There's individuals that say they're upset about SALT, individuals that don't like the Medicaid cuts. And then the biggest headache for Speaker Johnson has to be the House Freedom Caucus. These individuals are coming out like Ralph Norman and saying that bill in the Senate is a non-starter for us to vote for in the House.
They're focused on the details. I have to say, from the investors that have been on this program, they're not focused on the details at all. They just want to make sure that we see an extension of current policy and that's secured, the tax cuts from the first term of President Donald Trump, and that we just move on. We just move on from there, do something on trade, move on again, tech's back in a leadership position. That's something people are comfortable with, and stocks are close to all-time highs.
When you say people, when you say investors, I think we're talking stock investors. I think bond investors don't know what to make of this. They don't know whether the bond vigilantes have actually disappeared, whether they ever existed, or whether there actually is a real question around the deficit. And I do go to the Committee for a Responsible Federal Budget that came out with a projection that this would increase the deficit by more than $4 trillion for the next 10 years. And it raises a question of, will there be some acknowledgement of this in the bond market? Are we already seeing an acknowledgement of this, where yields would be substantially lower on the long end should there not be this concern hanging over about the deficit?
Wall Street Journal editorial board this morning calls it the meh tax bill that has to pass. Meh, M-E-H. And their last line is in, the bill is more than anything the triumph of GOP political necessity, and the end of tax uncertainty is its main virtue. This extension of policy, because there'll be tax hikes at the end of the year if they don't do anything.
We can explore the counterfactual. If we weren't extending current policy, we're talking about something much, much worse. We'd be talking about tax hikes for a lot of people, and I think we'd have to confront the idea that we'd be talking about an economic downturn, and you'd have low bond yields for a very different reason, and I would say that would be a bad reason also.
Well, the Fed would be cutting anyway, just putting all of this aside, because inflation is naturally coming down. Now you've got tariffs potentially juicing inflation, and you have a deficit increasing, and you have an economy that's chugging along. So it leaves the Fed in a very difficult position, and that is the reason why they are in wait-and-see mode, even though they're getting handwritten notes over different pamphlets from the president saying, please, what are you doing?
We'll talk about those handwritten notes a little bit later this hour. The pressure building on Fed Chair Jay Powell. More data later. If you're interested in where the bond market is right now, just a snapshot for you. Bond yields are actually higher this morning by 5 basis points at the very long end of the curve. So on 30s, your yield at the moment 4.81. Coming up this hour, we'll catch up with Sarah Hunt of Alpine, Saxon Woods, with stocks pausing near all-time highs. Former Speaker of the House Kevin McCarthy as the tax bill makes progress in Washington. And we'll catch up with the Counselor to the Treasury Secretary, Joe Lavorgna. Joe's going to join us a little bit later this hour. We begin this hour with stocks higher. Investors awaiting June payrolls and more clarity on trade policy. Sarah Hunt of Alpine, Saxon Woods writing, the momentum seems to be favourable as long as the economy holds up and earnings continue to come in with positive trends. Risks are still out there. Sarah joins us now for more. Sarah, good morning.
Good morning.
Question we've lent on a lot over the past few weeks is whether the worst of the data is still in front of us. And if it is, are investors going to be willing to look through it now we get some policy clarity?
I think if you do get some policy clarity, it's absolutely going to help. I think that the worst of the data ahead of us feels a little bit like long and variable lags that we were worried about a year or so ago with higher rates, that were going to make all these problems. And to the extent that people, including myself, were looking for some of that, it didn't really come through. So I think this is the reason the market is where it is, I think, besides good earnings, is that people are sort of having the realization, well, what if those bad things don't happen? Because if they don't, we've got some relatively decent runway if we get some of these problems solved. Because I agree with you on this bill. If you don't get it, then the tax raises take all bets off the table, and the market is absolutely expecting it to be a done deal.
The stock market is certainly seeing a half glass full and some, both in technology stocks and in bank stocks. And I wonder, of those two rallies in those two sectors, is there a sector that you think is a little bit more vulnerable as we work our way through the rest of the summer?
Well, I think that the banking sector got some relief on some of the issues that were really plaguing that. So I think that the banking sector is in pretty good shape. Technology has been much more run by headlines, where the slowdown in some of the data center spending or some of the data center booking that people were worried about at the beginning of the year had a big effect on that group. I think now we're back to actually it's going to be fine, and there's some bigger use cases, and that's making a big difference. And I think that that's something that everybody was looking for last year. As that starts to come through, I agree with Wei Li, it's a good place to be.
Just to build on that, last year people were looking at the shift from some of the big hyperscalers to the adopters. That was the story last year. It didn't come fully to fruition. It was sort of concentrated in the Magnificent Seven stocks in terms of the rally. Are you actually starting to see that widening out that would justify equal weight, that would justify not just hiding out in the two sectors that John named, which is the bank area as well as the tech sector?
Well, it's interesting to see the leadership come back to the tech sector, right? And I think that bounce back was so severe this year so far that it's left a lot of people in the dust, because the rest of the market has done okay, but not as well now that you've seen that return to performance. So I think that there is room, but you need to figure out why, and that's got to be on earnings and margins, and that's part of the AI story, that we can help earnings and margins. So all of that sort of comes together, but people are still more likely to be chasing the front runners in that than the people who will eventually benefit, at least at the moment.
How much is the stock market constrained by a bond market that doesn't know what to do? Because that's kind of what it feels like, particularly on the long end.
It doesn't really feel like the stock market's all that constrained at all right now, does it? I mean, we just hit another new high after big concerns and after that huge plunge in April. So I think that it's almost like we're acting in different ways again. Some of those original relationships between bonds and stocks that people look for, some of those correlations are out the window. And a lot of the correlations that we're used to seeing are not feeding the way that they necessarily textbook should. And I don't know that that's really making that much of a difference, but you get huge moves in yields in a quick period of time like we saw earlier. And yes, that can start to affect equity markets as well.
The reason why I ask this is because there was a belief a couple months ago that bond vigilantes would come out and would protest a bill like the one that we're seeing that would increase the deficit this much. Right now, you're seeing a marginal sell-off, but otherwise you're not seeing a lot of action. There's a real question about whether there will be a reaction, and if there is not, whether this is potentially another risk that's been taken off the table. How do you understand the concept of the deficit as it plays into the bond market?
Well, what's interesting is I was listening to Bloomberg yesterday, and somebody made the point that a lot of the bonds are, I think it was Bob Michelle, a lot of the bonds are in hands that are strong hands and not in dealer hands, that are in hands where people want to hold those to maturity. So the trading around them isn't as fast and as much as it used to be. The holders are now in places where they're going to stay there. So that makes a little bit less volatility sometimes, not all the time, because you certainly saw a lot of bond volatility. But the idea that there's a lot of money looking for a home and people put it in bonds, and at yields where they are right now, they feel pretty comfortable with that on the longer term. So that trading fastness isn't quite as bad as it used to be.
If you want to express your concern with the policy in Washington, then where do you do it? Is it just dumping the dollar?
I think that's been part of it, but I think it's hard to express that concern in a specific way because there's so many moving parts outside of the U.S. So what's going on in Europe, there were reasons to say, okay, let's get excited about Europe. Whether or not those reasons come to fruition is always the question with Europe, right? We're going to make all these spending changes. Are they going to actually be able to do it? I don't know what the answer to that is. But there was at least a fundamental reason to say, okay, I can get interested in this market now. And so therefore, I can move some of my money and I can change some of my hedging, which is also part of what's going on in the foreign exchange markets. So I think that there are ways to do that, but it's hard to pull apart each causality all on its own. And I'm not sure exactly how you would best express that. And getting out of the market hasn't been the best way to do that either.
When it comes to the question marks in Washington, D.C., these two self-imposed deadlines, we do know that at some point the bill is going to pass, whether or not it's Friday or not, and then July 9th. But after July 9th, how concerned should the market be about the sectoral tariffs that a lot of people say have stronger legal footing?
I think this is one of the big questions that when we start to talk about earnings are the driver of markets, right? So earnings are going to be affected by all of that. And one of the things that people got a lot of comfort with was good Q1 earnings and also the moving of those deadlines and whether or not those things were actually going to happen. As they start to come through, if they start to have a big knock-on effect on earnings, it's going to matter a lot more. Right now, there's still the belief that we're still in the negotiation phase and that even though we're going to have a deadline in another week, there's going to be more room to move around that as we've seen so far. Whether or not that comes true, this is exactly what happened in April. Everyone thought it's a negotiating tactic, then they thought, oh my goodness, this is serious, and now it's not a negotiating tactic. So I don't think we know what the answer to that is, but we certainly have a history to show that maybe there's more room in that play than we had the first time.
I'd take it an additional step as well, just to build on what you were saying. I think the market has also decided that the tariffs that are on and any additional tariffs won't actually lead to the kind of inflation bump that people were worried about. We've taken comfort from the disinflationary trend of the last several months, which is why this market is betting on rate cuts, even as the chairman is still going around saying they're not going anywhere anytime soon.
And part of the reason why is because of Fed officials like Mary Daly, who came on surveillance and said that she seems to be leaning toward this idea that you're going to get a one-time price increase, but after that, there isn't going to be this long-standing inflation that remains in the system. That seems to be what people are coalescing around.
Sarah Hunt of Alpine, Saxon Woods. Sarah, thank you. It's good to see you, as always. Let's get you a quick update of news elsewhere with your Bloomberg brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. President Trump's tax and spending bill is back in the House after barely passing the Senate with a tie-breaking vote from Vice President J.D. Vance. Now it's running into resistance from Republicans who don't like some of the changes made in the Senate. Moderates are worried about Medicaid cuts, and fiscal hawks are vowing to oppose it over its impact on the deficit. Meanwhile, we're just 1 week away from President Trump's self-imposed July 9th tariff deadline. That's the cutoff point for countries to strike deals with the U.S. or see higher tariff rates. The president says he's not considering any delays, and he's renewing his threat to cut off talks and impose higher rates on several nations, including Japan. And Iran is said to be cutting off communication with key UN nuclear officials. Sources telling us here at Bloomberg that Iranian regulators have stopped taking calls from the IAEA after formally ending inspections last week. Tehran had previously allowed an average of more than one IAEA inspection a day, but the Israeli and U.S. assault has changed the equation. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, facing opposition in the House.
85 to 90% of this bill is the House-generated product. The Senate made some modifications to it. We're at the 1 yard line in this game that we're going to run it right up the middle and score for the American people.
Unique up insight just around the corner from former Speaker of the House, Kevin McCarthy, live from New York City this morning. Good morning. Quiet morning for the S&P 500 so far, positive by about 0.1%. A bit busier in the bond market, yields higher at the very long end of the curve. Things can change later. 1 hour from now, we'll get some ADP jobs data. Under surveillance this morning, looking down to D.C., facing opposition in the House.
85 to 90% of this bill is the House-generated product. The Senate made some modifications to it. They made it more conservative in some places and moderated it a little bit in others. This is no longer just a House bill. It's not a Senate bill. It's the bill of the people, of the hardworking American people, and we are going to deliver it by July 4th. We're at the 1 yard line in this game that we're going to run it right up the middle and score for the American people.
Here's the latest this morning. President Trump's tax and spending bill hitting a little bit of resistance in the House as Republican lawmakers return to vote for the Senate's version of the legislation. Joining us now is Bloomberg's Tyler Kendall. Tyler, let's talk about that self-imposed July 4th deadline. How are things shaping up?
Yeah, hey, John. Well, it's by no means a done deal, though President Trump is ramping up the pressure on House Speaker Mike Johnson to thread the needle here because he can only afford to lose 3 Republican votes. And we already know of 2 likely no's since they voted against the package back in May. That's Congressman Thomas Massie of Kentucky, who's actually facing a Trump-backed primary because of his no vote. And then also Warren Davidson of Ohio, who has raised concerns about deficit spending. And it is perhaps this group of lawmakers who are pitching themselves as fiscal hawks, many of them members of the House Freedom Caucus, who ultimately say that they're not going to be able to support this bill unless they see some sort of further commitment when it comes to this, since they think that the Senate fell short by about $500 billion in promised spending cuts. Though we should point out that their counterparts in the Senate, like Ron Johnson and Rick Scott, ended up voting in favor of this bill, so they might not have allies in the upper chamber to make any sort of significant changes. Because at the end of the day, there's pretty broad agreement about the core pillars of this package when it comes to the tax cuts, but but it really is the spending cuts that we're seeing prove the most contentious. And that's why I'd say we should also keep our eyes on some of these moderate Republicans in some critical battleground districts who have raised concerns about changes to Medicaid. Not necessarily tightening the work requirements, but that the bill would actually lower the Medicaid provider tax, which could mean less federal matching funds for these states that expanded coverage under the Affordable Care Act. And John, we actually heard from 16 of those Republicans who signed a letter last week saying that they would not support this bill if it did lower Medicaid provider taxes. But we should say that in the final compromise that the Senate had, it did boost something known as the Rural Hospital Fund in a bid to try to get some of these lawmakers over the finish line. We're going to have to see if it's enough and whether any of them are willing to defy President Trump.
Tyler Kendall with the latest. Tyler, thank you. Hoping to avoid some ping pong between the House and the Senate. Joining us now, a man with experience of all of this, the former Speaker of the House, Kevin McCarthy. Speaker McCarthy, welcome back to the programme, sir. It's good to get your thoughts. I want to lead with a question that Annmarie asked a little bit earlier on the programme. When you're herding cats on Capitol Hill, is it easier or harder when the President of the United States is Donald Trump?
Oh, it's so much easier. President Trump is stronger today than he was at any time in his political career. President Trump is stronger in the House. Remember, just to get this bill out of the House, they all said they weren't going to vote for it. President Trump came down to a conference, told both sides from SALT, it's over. From the Freedom Caucus, that's over. Everyone who said they wasn't going to vote for it, voted for it in 24 hours. So this bill's going to get passed. The only thing that's holding up when this bill gets passed is the weather in D.C. and the attendance of how that people get here.
Well, yeah, people now have to come back to Washington when they thought they were going to have this week off. Speaker McCarthy, so you think the Freedom Caucus will fold again? Will they fold by July 4th?
I believe so. I mean, think about this. Mike Lee, Rick Scott, Ron John all voted for this bill in the Senate, and they're not going to vote for it. So if they don't want to vote for it and they vote no, they're sitting with the Democrats and want to increase taxes. They have no place to be. What they want to do is get the attention they always crave, so they talk about that now. But how many times can you cry wolf and say you're not going to vote for something and in 24 hours vote for it? They have done this numerous times. They want the president's attention. They say this so they can go down to the Oval Office and see the president and go back home and say they saw the president.
So do you think the rule vote, which comes first, will pass? Because we can't see the bill on the floor until that goes through.
I believe, yes, it'll pass. It's all going to come down to attendance today. How many people could make it to D.C.? A lot of flights were canceled, so do they have to delay it a day or not? But this bill will pass. Remember, it already passed the House. It has now passed the Senate, and you've got the July 4th deadline holding right behind you. There's a lot of pressure mounting here. President Trump has done a tremendous job on this, but he has become the speaker in the same time frame. Every time he's leaned into a bill, it's been able to pass.
He's the closer. He's the speaker in chief. How concerned are basically just congressmen and women about being torched on Truth Social like Thomas Massie?
Well, you look at Tom Tillis. I mean, Tom Tillis, who had a lot inside this bill, was pushing people to put more inside the bill, turns around and decides not to run for re-election. I think that plays on the mind of a lot of individuals. And people are now being able to look at the bill. At first, they're always arguing about what's wrong, they're not really looking at what's positive with it. You're not raising taxes. You're actually getting the economy moving again. You're keeping your promises. For those who are sitting in SALT districts, and you had a list up there of people who are leaning no. Nick LaLota, he said he's for this bill. That's a big movement for, because he actually improved SALT for his district. When it was 10,000, it's now 40,000. He can go back home and champion what he was able to achieve
but at the same
while
time,
he was in Congress.
If he votes,
that's a victory.
At the same time, though, there really won't be a cap. The cap expires at the end of the year. So don't you think the SALT caucus does have some leverage?
No, goes after 5 years. No, from the same standpoint, it wouldn't totally go away, or people going to let these taxes all go away. He'd been able to achieve something while keeping taxes low. If he wanted SALT to go away, he'd raise taxes on all of his individuals and play that way. That's not why people elect him. They elect him there to go legislate, and that's exactly what he did. He improved the lives of his constituents, and he can champion that and actually be celebrated back home.
Each of the constituents were trying to improve the life of their region. From an overarching federal perspective, which this is a federal law, do you think that this is a good bill?
Yes, this is a very good bill, because what would happen if you did not pass this bill, your taxes would go up. The economy would spur a little down. I mean, this is exactly keeping the promise. And if you want to put it in perspective, this bill is exactly what President Trump campaigned on, so the American people voted for that. He won the popular vote, something a Republican president has not done in more than 30 years. He says no tax on tips. It's keeping his promise, and this is the first thing people look at. And even if you didn't vote for him, you respect that. You kept your promise. That's a change. Well, you said you'd secure the border. You secured the border.
With all due respect,
you said you would move it and make sure the tax would done. Yes, whatever respect you want to give me, I'll take.
I'll give you loads of respect. There's a real question right now about the deficit increasing and the fact that there is a perception, and it was edified by the Congressional Budget Office, saying that essentially this would take money out of the pockets of the lowest income individuals in the United States, and it would add to the higher income individuals significantly in the form of tax cuts and other potential benefits. That isn't necessarily one of the agenda items that was promised on the campaign trail, correct?
Well, all due respect to you, if you look back at the tax bill that we're keeping in place, what happened after it was placed? People actually got more income. Companies gave $1,000 checks to their employees. So the CBO can score it one way, but we know what reality is. We know what we're seeing right now as well, where the S&P 500 set a new record. So I think that lives much stronger to the American public than anything else. When they keep their promise, the economy's stronger, the border is secure, you're watching the Middle East go to a place we haven't seen in a long time, trying to end war in Ukraine. Yes, the world is a much better place because we elected President Trump. And yes, he is keeping his promise, and this aligns exactly with that, and America will be stronger for it.
Speaker McCarthy, I'd love to talk to you about your relationship with both President Trump and your friend Elon Musk. Are you being called in to try to mediate this feud we see?
I have not been called in, and I just know when two bulls fight, the only people who lose is the ground underneath it, and I don't want to be that turf. One thing I do know is when those two work together, there's nothing we can't achieve. So in the same mindset, I think people need to take a deep breath. Let's get back to where we were before. Let's put America first and find the way that we make everybody stronger.
Speaker McCarthy, with respect and thanks. Thank you, sir. Appreciate your time, as always.
Always.
Thank you.
Take care.
Thank you, buddy. Thank you very much. The former Speaker of the House, Kevin McCarthy there. I'm still in that line. Aren't you?
I think that's great. I'll take all the respect I can get.
I think he loved your first question because let's be honest.
Well, it's your question. Let's be clear.
Okay, but the point of the matter is, it is easier to be the Speaker of the House when the president is President Trump and not when he was Speaker of the House when it was Biden, because Trump basically does so much of the heavy lifting, whether it's Truth Social, having people over at the Oval. He gets these congressmen and women to the finish line without the Speaker having to really do too much.
That, though, is what I think was interesting about the last week or so. Your point is perfectly valid, but the extra wrinkle comes from Elon Musk, because Musk is the money man. And seeing division between those two individuals over this bill is a choice between pleasing the president and upsetting where the money comes from.
And the reason why this is particularly salient is because of being primaried. That is the real threat coming from President Trump. I'm going to put a candidate in there to run against you. Well, if you've got Moneybags McGee over here fueling your campaign, it changes the equation.
This conversation will continue down on Capitol Hill. The only thing stopping this bill from passing, apparently, is the weather in Washington. Up next, Matt Luzzetti of Deutsche Bank with markets counting down to June payrolls, plus Danny Berger with your morning movers, looking at shares of Tesla ahead of the company's second quarter deliveries. Here's a snapshot of the markets this morning. Good morning to you. Equity futures positive by 1/10% on the S&P. Just a small bounce, back from a small bounce of losses just yesterday. In the Nasdaq, we're looking at gains of just 0.02%. Much more interesting in the bond market. 2-year, 10-year, 30-year, steeper curve this morning, led by some losses at the long end of the curve. Yields higher by 5 basis points, 481.41. And over the past week, got to put the spotlight on what's happened in foreign exchange. Euro dollar. 9 days of euro strength, the longest streak, Lisa said it yesterday, since 2004 for the single currency. Some euro weakness this morning. Euro dollar back down to 117.63 after going through 118. Just got to flag some pushback building from the ECB. The vice president saying 118's okay, 120's all right. Anything beyond that, we might have a problem. Another official talked about this weighing on inflation. And another official, Mario Centino, earlier on this morning, the risk of inflation undershooting is greater than the risk of inflation overshooting. The Eurozone in a very different place to the United States.
At the same time, not signaling rate cuts. So it really raises this tension of exactly how they'll respond as Christine Lagarde has her eye on creating some sort of reserve currency in the euro and wants to really bolster it, even if it gets a little complicated over 120.
Euro dollar negative by 1/3% so far this morning. That's a single currency pair for you. Let's get you some single names in the equity market with more. Here's Danny Berger. Hey, Danny.
Hey, John. Just moments ago, Tesla was gaining more than 1%, but those gains starting to ebb. Had a really painful day yesterday, but this morning we got the figures from Shanghai. Their deliveries there ticked up for the first time for the first month of the entirety of the year. Of course, Tesla has been under immense pressure, especially in China, given the competition, given the politics. The issue is, and perhaps why we're seeing some of the gains wane, is that the tick up was only 0.8% year over year. Even so, there was some hope that maybe this represented something of a turning point, or at least things not being as bad. Now, to the downside massively this morning, it continues to be Centene, one of the biggest losers, down just under 29%. This is a health insurer. They've scrapped their guidance for this year because the money that they get paid to take on more sick patients looks like it's going to be less in many states this year. They could see a hit apparently as big as $1.8 billion. So with that scrapping, we're seeing shares trading at a 2017 low. Finally, rounding things out this morning with Adobe getting a cut in guidance from Rothschild's Redburn, downgrading how they see the stock, saying that there is just a lot of competition and it's eating at the moat that Adobe has and their ability to keep up prices. We also saw Figma, for example, file for an IPO yesterday, one of the big Adobe competitors. But the analysts there saying that by 2026, we're going to get fully editable and multi-layered videos, and Adobe is maybe falling behind there. John.
Danny, thank you. With the latest there, Adobe down 1.3%. And I'll raise out this morning, President Trump's tax and spending bill passing the Senate, heading back to the House ahead of a self-imposed July 4th deadline. Speaker Mike Johnson facing an uphill battle with some members unhappy with the Senate's version. Speaker McCarthy speaking to us just moments ago, saying the only thing stopping this bill from passing is the weather in the nation's capital.
Because every congressman and woman were basically back in their districts preparing for the July 4th parades and seeing all their constituents. And now what they're doing is they have to go back to Washington. They're going to be stuck there until they get this over the finish line. Because guess who is going to be truthing at them if they don't? And this was Speaker McCarthy, former Speaker McCarthy, his entire point. It is easier to be a speaker and really try to use that bully pulpit when Trump is the president. Because he's going to go on truth and basically say he's going to primary you if you don't get behind his one big beautiful bill.
If I were a moderate congresswoman, all I can tell you is right now I would be saying, absolutely, I'm not going to vote for it. I think it's horrendous. Give me your best offer. Because ultimately, what you have learned is if you do that, sure, you'll get called names. You'll say it'll be primaried, and then you'll be given all sorts of stuff for your people that you can go back and say, look what I got for you. So, watch for that. Watch the space.
To your point, it worked in the Senate. Why wouldn't it work in the House?
100%.
All over again. We want to avoid the ping pong. Said that a few times already so far this morning. The Fed chair still very much under pressure. He understands how it feels to be facing some tension with the President of the United States. He said this, though. And I think this is him responding directly to the criticism coming from the President of the United States, essentially saying the Federal Reserve would be cutting interest rates if it wasn't for the tariffs announced back on April 2nd.
And he said this before. We don't have a sense of exactly how this is going to play into inflation. And we are expecting to see a pop in the next couple of CPI reads. The dates on the calendar to watch: July 15th, August 12th, September 11th. Those are the three CPI prints that we get in the United States before the next Fed meeting, where the Fed is actually expected to cut rates, which is the September meeting. And this is really the question. Will that be enough? Is this going to really cause a pop in inflation? And will they have enough data to determine whether it's a one-time increase or whether it is prolonged in terms of inflation?
More economic data coming later. We're counting down to ADP on the job side of the dual mandate, and then payrolls tomorrow morning. Wanted to squeeze in Tesla. Deliveries expected to disappoint later on. Analyst estimates compiled by Bloomberg anticipating a 12% year-over-year drop following a 13% drop in the first quarter. This coming as CEO Elon Musk's feud with Trump ramps up once more, putting some pressure on the stock.
I remember when we didn't care about deliveries, when this wasn't a story about actual cars. It was a story about belief and faith and technology, and it still is for some people. This question of whether it is the robo-taxi front that really is going to propel this stock higher. But ultimately, that feud gets all the more important because that needs the president to sign off on certain regulatory oversight or frameworks to allow the robo-taxis to come. And the president was talking about cars blowing up yesterday, so who knows?
Is that what he was talking about?
Hydrocarbons.
EVs?
Hydrocarbon.
Okay, yes, okay.
Whatever, it was...
Should draw a distinction there.
The president says he didn't really like EVs, but he did buy one in front of the whole world for his entire staff to use, and I'm pretty sure they still have it.
Okay, that's the latest on Tesla. Some more data coming up a little bit later on both Tesla and on this economy. Investors counting down to the payrolls report. The estimate in our survey expecting 110,000 jobs to be added. Matt Luzzetti of Deutsche Bank writing something closer to 100K per month is now likely enough to keep the unemployment rate steady. Matt joins us now for more. Matt, good morning. It's good to see you.
Good to see you too.
This is the key debate going into payrolls, that we've taken this step down, that you can have numbers around 100K, and that doesn't mean you're increasing slack in the labour market. What's changed?
Yeah, so I think to put this into context, if you go back to last year, there was San Francisco Fed analysis that was saying the break-even number for payrolls was above 200,000. And that was reflecting big immigration surge, big pickup in labor supply. And to absorb that labor supply, you just needed to add 200,000 plus jobs. I think as we look ahead, that's just changing materially. You cited the 100,000 number there. It could be even lower than that. If you think about immigration flows, both the fact that we're not having inflows coming in, but also deportations have picked up, it is very possible that the break-even number is 50 to 75,000 as we look ahead. And that just means, as economists, as the market, we need to view this jobs report within a different context. 50 to 75 this year could actually be a fine payrolls number. But as you note, I think it would be most important what happens with the unemployment rate, what happens with other measures of labor market slack, and what happens with wage growth, because that determines the Fed's policy.
That determines whether it's a good number or a bad number, since the headline number doesn't matter. I'm looking right now at Citi analysts. They came out and they're expecting 85,000 total payroll job growth, but they're expecting the unemployment rate to rise to 4.4%. Would that be a bad read? And how does it differ from what you expect?
That would be a bad read. I think if you get a 0.2 rise in the unemployment rate on Thursday, the market is going to respond quite negatively to that. Our own expectations are 100,000 for jobs and a 4.3% unemployment rate. If you go back to the May jobs report, it almost rounded up to 4.3%. We were at 4.24%. So I think you need to view the headline numbers in the context of the overall report, in the context of what we get from JOLTS and those data points as well. I think the JOLTS data yesterday, which was for May, backward looking, but nonetheless was a solid report. The quits rate rose, the layoff rate was lower, job openings picked up substantially. I think that's a report that could allow the Fed to continue to say the labor market is solid, pending tomorrow's jobs report.
I feel like this is defining the word "the." Everyone looks at the same data and comes out saying it was solid, and other people say, look, it was really weak if you look under the hood. The JOLTS data in particular, you did see a rise in the headline number of job openings. But when you take a look at where these openings were, it was leisure and hospitality. And there's a theory out there that this is a direct ramification from immigration policies. There aren't enough immigrants for some of these areas, so they have to hire other workers and quickly. And that's one reason why quits are up. And you could see this one industry kind of skewing all the results. What's your response to that?
Yeah, so I think in the other data points, such as quits, you actually saw a more broad-based kind of increase in stabilization. You're right that on the job openings data, leisure and hospitality was a key driver of that. When you look at the other elements of the report, what you see is total separations did pick up. So it does look like they're losing jobs. The quits rate did actually pick up for leisure and hospitality meaningfully, so that could reflect some decline in labor supply. Hiring is picking up substantially alongside of that, so it does look like they were able to actually fill those jobs in May so far. And I think it's just a really interesting early read on what a negative shock to labor supply could do to the labor market, because the quits rate's higher, job openings unemployed is higher, it's signaling higher wage growth in the leisure and hospitality sector. So it could be actually a tightening of the labor market. Now, could you get a sequencing issue here where payrolls are actually a little bit weaker before you get that tightness? I think that's always possible.
Building on Lisa's question, the individuals now potentially going for those jobs in leisure and hospitality, are they asking for more wages?
So we don't really see it yet, and again, that kind of might be a timing issue, but what I'm looking at is the quits rate leading wage growth. The quits rate has picked up substantially in leisure and hospitality. It's actually picked up a little bit in construction as well. It is giving you a forward-looking signal that wage growth could be picking up in those sectors as we look ahead.
Just got some data from Challenger. I always wonder, what am I meant to do with this data? This is the headline for you. First half 25 job cuts, 744,308, the most since the first half of 2020. Sounds absolutely dreadful. First half of 20 was dreadful. What is this data? What does it mean to you?
So I was looking at the same data. If you actually look at the data for June, it declined substantially. It's actually down year over year. And so the pickup in job cut announcements that they have was primarily 3 or 4 months ago. and it was primarily government-driven. So they highlighted several 100,000 of government job losses. I think as you look through broader data, there's just really no evidence that layoffs have picked up. Initial jobless claims are actually quite low. The JOLTS layoff data yesterday actually declined. The Challenger data today was actually lower than it was a year ago. But it's a labor market that is defined by low hiring and low firing. And so, if you have a job, you're doing quite well. If you don't have a job, it's difficult to find one.
Final word on the Federal Reserve. You put out a piece in the past few weeks, thought it was fantastic. The difference between division and uncertainty at the Federal Reserve. What's the importance between the two? What's the difference? And where do you settle, you and the team?
Yeah, I think the thing is, you look at the Fed's forecasts, they talk a lot about uncertainty, and no doubt there's a lot of uncertainty, but the modal difference between a lot of them is not all that large. What is very different is that if you look at the two most likely outcomes for Fed officials this year, it's 0 cuts or 2 cuts. It's a 50 basis point difference, and we're only 6 months out from that outcome. It's very unusual that you have that degree of division, and you've just very clearly seen that in the Fed speak as well. You've had some Fed officials coming out talking about a July cut as early as July, while most other Fed officials, including the chair, I think has indicated that seems unlikely.
Chairman also herding cats down in Washington. He's not the only one. Matt Luzzetti there of Deutsche Bank. Matt, thank you, sir.
Thank you.
Appreciate it. Thank you, sir. More data later on this morning. Keep repeating it. 8:15 Eastern Time, the ADP employment report. With an update on stories elsewhere with your Bloomberg brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. French President Emmanuel Macron and Russian leader Vladimir Putin had their first phone call yesterday since 2022. In their discussions, they agreed to coordinate their approach on Iran. Sources telling us here at Bloomberg it's part of an effort to forge a common approach on Iran between the permanent members of the UN Security Council. Meanwhile, Paramount Global has reached a settlement with President Trump. This over a lawsuit alleging election interference by CBS News when it showed 2 different versions of a 60 Minutes interview with Kamala Harris, airing just before the election. Paramount agreed to pay $16 million, including plaintiff's fees. Trump had sought damages of $20 billion. And in sports, top-ranked tennis stars are having a rough go in the first round of play at Wimbledon. The tournament saw a record-tying 23 seeded players eliminated in the first round, including women's number 2 Coco Gauff. That comes just weeks after she won the French Open. Number 1 seeds Aryna Sabalenka and Carlos Alcaraz both take the court later today. That's your Bloomberg brief. John?
Sabalenka is absolutely awesome. Thank you, Yahira. More from Yahira in the next hour. Up next on the program, the president taking on Chair Powell.
No inflation. Our country is strong. Our interest rate should be 3 points lower. But we have a moron at the head of the Fed. He's a moron.
That conversation up next with Joe Lavorgna, the counselor to Treasury Secretary Scott Bessent from New York. This is Bloomberg. Equity futures just about positive. We're up 0.1%. Not much price action this morning on the equity side. The Russell doing nicely. The small caps up by 0.7%. Under surveillance this morning, the president once again taking on Chair Powell.
No inflation. Our country is strong. Our interest rate should be 3 points lower. If our interest rate was 3 points lower, that's almost $1 trillion in cost. And it's done just by the signing of a pen. But we have a moron at the head of the Fed. He's a moron.
It's the latest this morning. President Trump piling the pressure back on Fed Chair Jay Powell to cut interest rates. Chairman Powell snapping back.
We went on hold when we saw the size of the tariffs and essentially all inflation forecasts for the United States went up materially as a consequence of the tariffs. So we didn't overreact. In fact, we didn't react at all. We're simply taking some time.
Joining us now to discuss this and a whole lot more on the U.S. economy, Joe Lavorgna, the counselor to Treasury Secretary Scott Bessent. Joe, welcome back to the program, sir. The words of Chairman Powell: we didn't react at all. We're simply taking some time. Why is his position not a convincing one?
Let me say this, Jonathan. The fact is that the tariffs, whether you look at the PCE, the CPI import prices, all those metrics actually decelerated. So not only did the consensus get it wrong, where inflation didn't pick up, it actually fell. The chair likes to look at the supercore metric, which is services excluding rents and energy. And that's actually fallen about a point plus, since last September when the Fed first began cutting. So many metrics show that inflation pressures are actually decelerating, which obviously means that real interest rates are expanding, meaning they're rising. So I don't want to be critical of the Fed per se. The president's done has given his own spiel and made some very powerful arguments why rates should fall. But there's no question the inflation news has been much better than anybody thought. And tariffs, as we've said many times, as Secretary Bessent has said, are not inflationary. Tariffs are, if they happen, and they haven't impacted the domestic economy, it's a price level adjustment.
But, Joe, we're still waiting for the tariff rates, and the president is saying he's not moving the date next week. When I speak to individuals that are sitting on the other side of the U.S. Trade Representative or Treasury Secretary Scott Bessent, they say that they have been told and given assurances by this administration that if they are in good faith negotiations, that deadline can be pushed back. Is that your understanding?
Well, that's what Secretary Bessent has said, and Secretary Lutnick recently said about 10 to 12 countries are very close to a deal. There's about another 20 that are also negotiating in good faith, and Secretary Bessent recently highlighted that many deals could be done by Labor Day. So there's a lot of good progress. But on the tariffs, I just want to be clear, the consensus view among almost everybody was that tariffs would start to impact the data in March. It didn't happen in March, it didn't happen in April, it didn't happen in May, and we know there's a big number associated with the revenue. We could have $300 billion of tariff revenue this year that's coming in. So we've got this huge increase in revenue. So they're there. And the reason the tariffs aren't impacting things in large part is because foreign producers, as we learned from the first Trump administration, are absorbing it in their margin.
When it comes to Japan specifically, the president said that they're spoiled. And he talked about the fact that maybe he's going to go for a 35% rate. On a Liberation Day, they only had a 24% rate. Do you see any country going above April 2nd rates?
The president is a very tough negotiator, and I'm confident that whatever winds up happening with Japan and everyone else is going to be in the U.S. best interest. This is a negotiation. And again, as Secretary Bessent's highlighted many times, as long as countries are negotiating in good faith, that's a positive, and then we take it from there. But I do expect, as the Secretary said, there are deals forthcoming.
The market response to all of this has been pretty much a shrug. We've seen new record highs for equity markets, except the dollar has continued to weaken and weaken to some of the lowest levels, weakest levels going back to 2022. At what point is that a concern for you?
Lisa, first of all, a lot of that weakness is vis-a-vis the euro. If you look at the Fed's real broad trade-weighted index, which is about 26 countries, as opposed to, I believe, the Bloomberg DXY, I think is only 6 or 7. It's a small sample. If you look at the real broad trade-weighted index, it's close to one of the highest readings we've had since the Plaza Accord back in 1985. So this notion that somehow there's the selling of U.S. assets, that the dollar is weak, some major financial outlets have talked about that. It's completely incorrect. It's not consistent with the tick data. It's not inconsistent with the recent BIS report, which talked about some of the selling of assets in April. That brief period of selling was actually due to hedging. It wasn't due to lack of demand for U.S. assets. So the dollar is the reserve currency. The dollar will be strong. The dollar is still strong. And I think those concerns are greatly misplaced.
There is, though, this building worry about monetizing the debt in order to pay for some of this bill, this idea that you want to run the economy hot, this emphasis on growth in order to offset the increase in the deficit at the same time that you're counting on inflation not to pick up. How do you sort of square that, the idea that in the past, when you run the economy hot, it typically has come along with inflation, especially at times where there have been disruptions to supply chains?
Yeah, well, in the first Trump administration, growth was nearly 3%. It actually hit 3.4% in the fourth quarter year on year in 2019, and inflation didn't pick up. The one big beautiful bill, which is making its way through the Congress, as you know, increases supply side incentives to get growth to remain robust through capital investment and capital deepening. Inflation will continue to fall. The inflation news has been great, and that's the thing. If you look at the bond market, the equity markets rallied on a second-half boom, and bond market yields are down substantially from where they were earlier in the year. So the capital markets are really responding very positively to what they expect on the inflation side. Break-even inflation's been stable. So again, this notion somehow that inflation's going to pick up, that growth leads to faster inflation, this Phillips curve mindset, if you will, completely wrong. We saw under the first Trump administration, as I said, very strong growth and low inflation. And by the way, I just want to add, the big problem with the CBO's numbers is they're only assuming 1.8% GDP growth. That's woefully too low. If we have a 17.2% revenue share of GDP, which is basically where we are now, and we grow at a much more plausible and realistic 3%, that gives you something like almost an extra $1 trillion in revenue relative to what CBO was forecasting back in January. And that's not even adding the revenues that are coming from the tariffs. So this notion that these deficits are going to stay super high and grow, completely, I think, incorrect, because it's based on a fallacious assumption of sub 2% growth, which is very, very weak.
That's the argument the president's making this morning so far. Joe, just before you go, how much outreach is happening at the Treasury and from the White House just to communicate to the public that the payrolls report might change just the numbers, what's considered good, given the amount of immigration we had over the last several years, and what's considered good now is going to change, that maybe 100K now is actually a decent number when 100K a few years ago with mass migration crossing the southern border wasn't a good number. Do we have to reframe what's good and what's bad in this labour market?
No, I don't. No, I mean, as you know, the payroll numbers are subject to significant revision. The income numbers are actually been very good. If you look at the compensation figures in real terms, they're accelerating. If you look at blue-collar wages, average hourly earnings for non-supervisory production workers are up almost 2%. The first 5 months of President Trump's term, that's the best 5 months effectively to start a new administration ever, going back 60 years. So the income trends are great. The unemployment rate's going to stay low. And again, if we get the one big, beautiful bill, Jonathan, that is going to get rid of a lot of the uncertainty that's there in the market, where companies can make capital plans accordingly. They're not worrying about tax rates going up. Because, again, if you look at small businesses, the pass-through businesses, the Chapter S companies, they're paying the marginal rate. So when they get some certainty on that and they create 40% of the jobs, you're going to see the labor markets tighten and growth accelerate in the second half of the year.
Hey, Joe, appreciate your time, as always. Joe Lavorgna there, the counsellor to Treasury Secretary Scott Bessent on the labour market there. No worries about the jobs market into Thursday payrolls.
No, it's hot, and that's essentially where we're at, and it gets revised. So if it's a bad number, look for the revision.
Could make a good Fed speech. Hey?
Oh, you think? Oh, is that where you're going to go with this? All right. Okay, well, you can keep
Chairman Lavorgna.
Yeah, who else?
How's that work? You know, might work out. Up next, the third hour of Bloomberg Surveillance, just around the corner.
There's broad participation in the market, but the magnitude of the upside is just in a handful of names.
It's been a very nuanced move in terms of inequity.
There still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries.
We're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback.
The risks are known, and once the market kind of knows risk, they can deal with it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The third hour of Bloomberg Surveillance starts right now. This hour, a focus on jobs data. The ADP employment report about 15 minutes away. The scores going into it look like this. Equity futures totally unchanged on the S&P 500. Down some 0.2% on the NASDAQ 100. Anticipating the big one tomorrow morning, 8:30 Eastern time. The payrolls report just around the corner. A lot of economists coming on this program in the past few days or so, preparing us for a low number. Peter Cheer of Academy, there is a real risk the data is very disappointing.
And part of the disappointment stems from the fact that we're just in a low churn market with less dynamism and fewer workers, particularly because of the decline in immigration. This is what I think you were getting at, and I thought it was a really good question to Joe Lavorgna about how does the administration message this at a time when potentially a low number doesn't mean that everything is falling off a cliff. That said, it raises a question about whether the new market is less dynamic, less forgiving, and potentially more fragile to any potential shock.
Kevin Hassett, the NEC director, come on down. We need to have that conversation, don't we?
I think it's important. What do you say if it's a really low number? Do you still say that this is a robust economy? Do you say this is reason for Fed Chair Jay Powell to cut? Do you say it's fake numbers and will get revised, or all of the above and see what sticks?
Most of the people that have come on the program have said, yes, I expect a low number, but the low number isn't a bad one, and look elsewhere. Look at the unemployment rate. You could have something like 100K, but unemployment wouldn't actually climb.
And if that's the case, is it okay? Is this fine? Is this good enough to suggest that, yes, this is a solid labor market that doesn't cause the Fed to have to cut rates in July, but it isn't necessarily a red alarm in terms of equities? So you're in this Goldilocks scenario where you could still get a rate cut in September without the risk-off kind of move that you could get in equities.
Can you look through weakness because we're getting clarity elsewhere? That's the theme of the next hour or so. Clarity on two issues, on taxes, on trade, down in Washington.
Speaker McCarthy, the former Speaker of the House, who knows a lot about how procedurally this is all going to work, says the only thing holding up this passing through the House of Representatives is the weather in Washington, D.C. And he seems pretty optimistic that the Freedom Caucus will fold once again, like they did in 2017 as well, when it comes to this bill, and that maybe this gets on the president's desk July 4th. After that interview with Joe Lavorgna, the tariff situation seems to be a bit muddled. You have the Treasury Secretary Joe Lavorgna coming out and saying, well, we have to Memorial Day. The president made it very clear yesterday there will be no extensions and we have till only next week, July 9th. But classic Trump, escalate to de-escalate, maximalist approach at the very end of a negotiation to try to get the most concessions when it comes to these trading partners.
Policy matters to markets, not just in the US. Check out the UK this morning. Seen in Parliament a little bit earlier when the Prime Minister did not back his Chancellor 100%. And what looked like a tear rolling down the cheek of Chancellor Ives. Well, a tear rolling down the cheek of this bond market in the UK at the moment. Gilts are down, yields are higher by 15 basis points. Sterling, with that move, is weaker, not stronger. That's the kind of toxic mix that you don't like to see in developed markets.
Losing credibility, which is a real question, especially as some of the key people in the seats that are in charge of these policies are undermined on some sort of level.
Yields up, sterling weaker. More on that story later this hour. Coming up this hour, Jim Caron of Morgan Stanley, with stocks holding a three-day winning streak. Dan Ives of Wedbush on the feud between Trump and Musk, and Kathy Bostjancic of Nationwide, with Fed Chair Jay Powell very much in wait-and-see mode. We begin this hour with stocks steady ahead of payrolls due out tomorrow. Jim Caron of Morgan Stanley writing, we think data slogs through, which provides room for upside earnings surprises in the second half of the year. Jim joins us now for more. Jim, good morning.
Good morning.
You've said it. This is the half where maybe clarity replaces uncertainty. A reason to be confident?
I think it is. Look, there's a lot of things that are going on. I will agree with the fact that I do think that the data is going to weaken. I think that the growth rate is going to fall. I think the unemployment rate is going to rise. And I believe that inflation due to tariff pricing is going to rise. This is exactly what the Fed's forecast is. My next question is, will that matter to markets? The markets know this, right? We know this, that this is happening. Yet when you look at equity prices continuing to push through, it begs the question, what else is going on? And what I think what else is going on is that the markets are looking through this as a soft patch, and they're thinking about 2026. They're thinking about this tax budget, one big beautiful bill, as they call it, and that adding some potential stimulus, CapEx, spending, AI, productivity, all these various things. All I'm saying is that I think that people are underappreciating the risk to the upside. And you've heard me say that many times before on your show, the risk to the upside.
You're not alone. We've talked about a pain trade being the equity market moving up and to the right and not down. I want to understand, just to stress test the theory a little bit, what happens if we get a big downside surprise tomorrow on payrolls? How forgiving are we in this market?
So I think the Fed has primed the pump to cut interest rates, right? I don't think it's coming in July, but it could come as early as September. If you start to see some weakening in the labor report, I don't think that Powell will be able to resist that. I think he's going to have to cut. And he could start cutting aggressively. And this is what I call like the upside convexity to prices. So we're in a situation right now where we do think that as we move into 2026, things could get better in terms of earnings growth rates, and what have you. On top of that, you could have yields going down. Remember, yields are supposed to be going up because of this budget, not down, and they've been relatively stable. So we have to bring this all into the mix and really think about this diagnostically and come to a conclusion.
Which really kind of leaves the bond market in the same place that it's been, at least in the long end, for quite a while, which is the reason why people have gleaned some comfort from that. On the earnings side, though, there's been huge disagreement on the street about how much the tariffs are going to cause a hit to profit margins. Yeah. You take the other side of what the Goldman Sachs analysts recently put out, which is it's going to be a bigger hit than we can currently expect. Why?
Well, I think that we have to understand that we have to look at the run rate of this. So if we look at first quarter earnings, the delivery of first quarter earnings were relatively strong. Normally, analysts would take up their earnings estimates based on that, but they didn't. They took them down because you got into April, you got into all the tariff-related activity. Second quarter earnings are probably going to be relatively decent, right? We'd likely have good second quarter GDP growth, just a recovery from the first quarter. So the way that we estimate it, it's not that the earnings rate is going to necessarily accelerate higher. It's just that the estimates from many analysts are relatively depressed to where they otherwise ordinarily would be, given the recent run in earnings that we've had. In other words, in a normal year, you would have seen earnings upgrades by about $10 to $12 right now. And what you've seen is a decline in earnings by about $10. So essentially, what I'm saying is that the markets could have the earnings number underestimated relative to the run rate of what it would be by about $10. So I think there's some cushion here.
How much is that story divorced from the underlying economy? How much is it focused in artificial intelligence and tech companies and banks that have gotten deregulated? Look,
CapEx is the mother's milk, right? So who's investing right now? Large cap tech. Who's been doing really well over the past couple of months? Large cap tech. What we have to recognize is that in this deficit, or in this budget bill, I should say, and I know it does add to the deficit, but in this budget bill that's coming through, productivity is a large portion of this, and the removal of a lot of government oversight and shifting government-sponsored growth into more private sector-sponsored growth is a real positive. It's really hard. You can't go on your Bloomberg terminal and say, how is deregulation doing today, up or down? Like, what's the tick? We can't track that day to day. There's a number of policies. Look at the ESLR, the Enhanced Supplementary Leverage Ratio, right? This has dropped Treasury yields by quite a bit. This is a meaningful impact. Do people talk about within this budget plan all of the deregulation that's going to be codified, that's going to remove some of the government, actions, on companies? That's the positive. That's what companies are seeing. That's why they're investing. That's why they're spending. That's why they're doing the CapEx. We've complained in the past they have no visibility. Once this budget passes, I think they're going to have visibility. I'm not a cheerleader for the Trump administration. I am just calling balls and strikes here. This is the way that I see this unraveling, and I believe it's underappreciated by markets.
That's one part of the policy uncertainty, though. What about companies dealing with the headwind of tariffs?
So this is a good question, right? So essentially, how much have the tariffs been absorbed by either the consumer or by companies and profit margins, right? So ultimately, the way that we think about it is that tariffs are a tax on profit margins. We've seen that. And essentially what the markets have said is once we know what the tariff rate is going to be, and we are closer to certainty on this, right? We're getting closer to knowing exactly what the effective rate is, that what markets are saying is that this is a one-off price shock. Companies will absorb this. It's definitely a hit. This is why 2025 looks a little bit worrisome. But then going into 2026, it's like you clean the slate and you start to move forward because it's not an ongoing thing. But markets are forward-looking. So if we think this in 2026, it's going to get priced in 2025 at some point. It might not be until the fourth quarter, really, but I think this is what's going on.
It speaks to what's happening elsewhere. Goldman bringing in their first rate cut call for the Federal Reserve. Jan Hatzius and the team going to September from December. That seems to be the direction of travel at the moment.
Because they don't necessarily see the price shock continuing past that. I just wonder, if you have a market that's being, or an economy rather, that's being run hot, can we get the growth that President Trump is talking about without the inflation that would accompany it, without consumers accepting higher prices and companies getting used to that and kind of liking it and doing it again?
He certainly thinks we can get that growth sometime soon. I hope we can. Jim, this was a clinic as always, sir. Thank you.
Thank you.
Appreciate it. Jim Caron of Morgan Stanley. If you're following events in the UK, it's difficult to keep up at the moment. We'll get you an update in just a moment, but I'll bring you this price action just briefly. Sterling was a whole lot weaker. It's bouncing back just a touch and then rolled over again. We're negative by 0.7%. The move in the bond market, yields higher on a 10-year maturity by some 14 basis points. With an update on that and more, let's get to your Bloomberg brief with Yahira. Hey, Yahira.
Exactly, John. Well, that's because UK Chancellor of the Exchequer, Rachel Reeves, visibly upset during this morning's PMQs, as you can see in this video. That's because when Prime Minister Keir Starmer was asked to repeat his pledge that Reeves would be in her post at the next general election, he avoided answering. Starmer's office adding later that Reeves has not offered her resignation, the UK Treasury saying any tears were due to a personal matter. Meanwhile, here, President Trump's tax and spending bill is back in the House. After barely passing the Senate, Vice President J.D. Vance had to cast the tie-breaking vote. Now it faces another uphill battle by House Republicans who don't like some of the changes. Moderates are worried about Medicaid cuts, and fiscal hawks are vowing to oppose it over its impact on the deficit. Meanwhile, Manhattan home sales surged in the second quarter to the most in almost 2 years. According to appraiser Miller Samuel and brokerage Douglas Elliman, more than 3,000 co-op and condo purchases closed in the quarter. That's a 17% jump from a year earlier. Cash buyers, of course, drove the Manhattan sales. That's your Bloomberg Brief. John?
Pre-Mamdani, right? Yahara, thank you. Is this pre-Mamdani?
You think that people are just going to wholesale leave and go to Florida? You try the Florida weather right
I'm saying a lot of rich people have been wholesaling leaving down to
the
Florida.
governor of New York admitted it. She was asked, "You're going to raise taxes?" And she says, and they said, even on the rich. And she goes, "I can't lose anyone else to Palm Beach."
We're going to have this debate all through 2025, through to November. Up next on the programme, the Morning Calls, plus Dan Ives of Wedbush on the feud between the president and Elon Musk. That's coming up next, plus some jobs data in America, the ADP report just around the corner. What do you do with the ADP report? It's the question we ask every single month. Equities right now just about unchanged on the S&P. This number, anything but unchanged. It looks a little different this morning. Mike McKee joins us for more. Good morning, Mike.
Looks a little bad this morning, and it certainly will get Wall Street's attention and maybe a little bit at the Fed. But as Lisa will tell us, it doesn't really matter because they're not very accurate in forecasting the NFP numbers on Friday. But as you say, a negative 33,000 print. That's the first one in some time. We'll look that up. Right now, it looks like a lot of that comes from the service providing sector, down 66,000 jobs. Professional and business services lost 56,000, they say. Education and healthcare services lost 52,000. Now, remember, education and healthcare is the big number every month, the one that adds the most jobs in the payrolls report. The construction jobs were up 9,000. Everybody's been watching that to see if there's an immigration impact. And manufacturing jobs, they say, up 15,000. Remember, yesterday we got that ISM manufacturing number that hit a multi-month low of just 45. The other number that they put out is the pay changes for job stayers, 4.4% in last month. Job changers up 6.8%. Those are not numbers that, if they were accurate, the Fed would be particularly happy about. So overall, a really negative number, and we'll see what we get tomorrow.
But, Mike, I think this is the stress test of the moment. If you get a number like that one, and this one's terrible, but if we get something, let's say 50K tomorrow, is a low number a weak number? And we're going to be having this conversation. Is it about immigration or is it about the economy? Mike, how do you get a read on that at the moment?
Well, what you're going to have to do tomorrow, John, is first look to the unemployment rate, because that's what the Fed is going to look to as a sign that the economy is slowing. And then we have to deconstruct that. Is it because the labor force fell? Is it because there was a particular amount of hiring or a particular high number of people going into unemployment? So that's where I would look first tomorrow to get a feel for it. Now, obviously, if we get a very small number, 50,000, as you mentioned, that would set off a lot of alarm bells on Wall Street, but I'm not sure it would set up the Fed to do anything in July. All the focus there would turn to the inflation number on July 15th, and if they got a combination of falling inflation and bad jobs numbers, then it might put it on the table.
Mike McKee, thank you, sir. Mike McKee on this jobs report for tomorrow and the ADP number we just got just moments ago. More from Mike in just a moment. So if you're just tuning in, negative 33,000 on ADP. Now, typically we don't care about ADP, and maybe this morning most of you still don't care about ADP. But the conversation we're going to have around this number is very similar to the conversation we'll have going into payrolls tomorrow morning. Is that low number the consequence of tightening up immigration, and it's not something to worry about, or is it a reflection of a weaker economy? That debate is just going to be ongoing through today, into tomorrow, and maybe out the other side as well.
And the real issue, as Mike was talking about, is the Fed is sort of on the sidelines regardless because of the confusion around this number. You can't identify it necessarily as being bad per se, even though that is the first negative number going back at least 2 years. So even for ADP, it is unusual to see this type of number.
Even for?
Well, I mean, you can discredit them all you want, but there are certain trends to look
most
at.
months.
And but right now the market's not, because two-year yields fell from the high that they were, almost 5 basis points on the heels of this.
Down 2 basis points on a session now to 3.75. That's some of the price action. Let's get you some morning calls. First up, Wolf downgrading Stellantis to underperform, citing risks from North America to this year and next year's earnings. Our second call from Goldman, initiating coverage of Deckers with a sell, citing a less attractive risk reward than competitors in the short term. That stock is down 1/3 And your third and final call from Jefferies, upgrading Apple to hold, expecting pull in demand from tariffs to drive earnings growth. Let's stick with the Mag 7. Tesla shares under pressure as the feud between President Trump and Elon Musk reignites.
We might have to put Doge on Elon. You know what Doge is? Doge is the monster that might have to go back and eat Elon. Wouldn't that be terrible? He gets a lot of subsidies.
Dan Ives of Wedbush writing the following: we believe this situation will settle, and at the end of the day, Musk needs Trump and Trump needs Musk. Dan joins us now for more. Good morning, sir. What's that last line about? What does that mean? Why do they need each other?
I mean, Trump needs Musk, just given Republican support. And ultimately, at the end of the day, in terms of autonomous AI, Musk is obviously going to be one of the leaders in this country. So I think when it comes to the AI race and autonomous, Trump does need Musk, as well as obviously Republican support. Musk needs Trump, because fundamentally, you just cannot have this BFF situation now go to an enemy in the White House, especially when it comes to the autonomous roadmap, which is so important, not just for Musk, but of course for Tesla.
Let's talk about one of the businesses, and it's the business that falls under your coverage. It is Tesla. The subsidies are going to be phased out, they're going away. This was anticipated. What does it mean for the business in the meantime?
Look, I think that was anticipated. I think the bigger focus here is it's all about autonomous. I mean, when I look at 90% of the future value is ultimately going to be about autonomous robotics, and that's the future. It all comes down to when Trump came in, the goal was that this is going to be a fast-tracked and autonomous roadmap in terms of a framework from a federal perspective. So I think the worry, and the reason the stock was down yesterday, is that still there? In other words, does this situation start to settle? I believe it does. But the last thing, as a Tesla shareholder or a Tesla bull, that you want to see is Musk just putting himself more and more into that political theater, because there's really no upside from a Tesla perspective.
Don't you have to push back your expectation for any kind of regulatory framework that would be beneficial to Tesla in the near term to get the robotaxi program off the ground?
Yeah, it's a great question. Look, it all comes down to China, because look, this is an arms race going on. So Trump knows Waymo has obviously been very successful, but still 5 cities, very expensive cars. The horse in the race is going to be Tesla in terms of to scale with what China is doing. So it comes down to, in this U.S.-China battle, Tesla, just like NVIDIA, is actually a chip on the table. So I do believe that you will actually continue to see this fast track despite this sort of back and forth that we're seeing. Look, it's essentially like a junior high situation, right? They went from BFFs, now sort of enemies, but I view this as something where for Tesla, it's going to be a near-term overhang that I do think dissipates.
Are investors pushing back more? Because this has been a faith-based stock for a long time. Suddenly we're getting deliveries that still don't matter, at least in your eyes or a lot of people's eyes, if you believe this really is a robo-taxi story. At what point do people say, really? We're not seeing it with the shares down 25% so far this year. And frankly, they're in an industry that is under a secular challenge at a time of a lot of potential headwinds and a lot of political drama.
Yeah, look, I think sentiment is as negative as I've seen it in a few years relative to especially the actual business. Deliveries, you'll get one this morning that's definitely going to be a pretty soft delivery number. But it does come down to, in terms of the prove-it situation, does robotaxi scale? I believe it's 20-25 cities in the next year. You start to see that in terms of geofence within Austin, that expands. They go to more and more cities. Then investors are like, okay, as an AI play, when you think about physical AI, NVIDIA and Tesla, to me, are the best pure play physical AI plays. But it's proving it. And now look, just like if you look at Apple and Tesla, they're in the penalty box from an investor. If you think about even Mag 7, where on the other side, of course, you got Godfather of AI Jensen, you got Redmond and Nadella, you have Meta and Zuck. So there's a separation going on. Apple and Tesla is right here in that penalty box.
I want to come back to when you said at the start, to John's opening line about how you think Musk and Trump both need each other. Doesn't Musk need Trump a lot more?
Of course. I mean, we've said that. It goes back
So
to
why
the
does he
whole-
keep poking the bear? Does that not unnerve investors?
Of course it does. Look, the last thing you want to see is him poking the bear. It comes down to like, there's nothing good going to come down in terms of him doing it. And I think that's why every time he does that, it just creates this cycle in terms of Trump, going back. And it's the last thing you want to see because, as we've talked about a lot on the show, obviously took huge steps back from Deutsche, Trump administration, took on a life of its own, but now he keeps shots across the bow. It's not what you want to see.
Just quickly before you go, quick word on Apple. Good or bad news, they're looking beyond Cupertino for the AI solution.
It's clock struck midnight. It's what they need to do.
You happy with that?
You cannot stay on the treadmill. Look, we were at WWDC. You almost fell asleep during that event, right? I mean, the point is that this is the time in the AI arms race. You can't be on the backwards treadmill time warp back to 2017, where every other big tech company is going forward. Perplexity, Anthropic, they need to do something big.
I don't believe you ever sleep, but I'm pleased you admitted it. Whenever I see those events, I often fall asleep, don't you?
Yeah, but you don't fall asleep if your shirt is bright enough to keep you awake.
No, everyone else doesn't fall asleep.
I love it. Yeah, exactly.
The room lights up.
Just start to wonder about the paper clips. Love the paper clips.
Yeah, exactly. And I look, I mean, the point is, I think Ferro is someone like at an F1 race, he could pull this off.
Oh, you think so?
Okay, all right. Thank you, sir.
Not sure about that.
Dan Ives of Wedbush. Up next on the programme, Kathy Bostjancic of Nationwide on a big downside surprise on the ADP report going into payrolls tomorrow. Plus, Danny Berger with your morning movers and some optimism for that name right there, Apple. The stock is higher by 1.2%. Futures elsewhere just turning a little bit negative in the bond market. Yields down, as Lisa pointed out. The front end of the curve will lower by 2 or 3 basis points to 3.75. Let's just say this. If tomorrow at 8:30 Eastern Time there is a negative sign before the number, equities won't look like this. Equity futures on the S&P, totally unchanged. On the Nasdaq 100, we're down by 0.2%. Moments ago, 15 minutes ago, negative 33,000 on the ADP report. Now, this is a report that typically people don't put much weight on. They question the credibility of it. Not a great read-through for payrolls tomorrow, but an interesting conversation. Nevertheless, in the bond market, with yields down a single basis point, 3.76. Is it immigration? Is it the economy? Or is it just ADP?
Which is really the reason why you're not seeing as big of a reaction as you would be seeing, as you said, if this were the numbers tomorrow. Look, it's the first negative number since March of 2023 at a time when you're seeing a shift in the composition of where jobs are being gained and where jobs are being lost. And Mike McKee did a great job of highlighting how in the goods-producing sectors you're seeing job gains. In the services sectors, you're seeing job losses. This doesn't cohere with the JOLTS data. This doesn't cohere with a whole host of other things. And it does raise a question about a one-time shock from immigration, but still something to watch.
Something to think about.
Yeah.
Got a message from a Bloomberg subscriber. Always say far smarter than me. Smartest audience in the world. Turned around and said, is this the future? The AI economy? Where the output data is pretty decent, but the jobs data is not great.
This is my fear, and that's why we keep saying the economy is not the stock market is not the economy. You ask Jeetu Patel of Cisco, who is it going to be good for? Is it going to be good for profits, or is it going to be good for humans? He was saying both. How long does it take to get there? And right now, are we going to see the equity market continue to diverge from a labor market that's kind of churning under a lot of change?
Too much doom. We're done. All right,
Okay.
that was enough of that. If you're just waking up this morning, good morning.
It's
Tell you
great.
what, we'll save that for another day. Not good stuff. 1 hour away from the cash open. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John, we have to kick it off with Centene again because we're at the lows of the morning for the pre-market session for this health insurer company. Completely scrapped its guidance for this year, saying that it was looking across states and it appears that the amount that they usually get compensated in order to take on more sick patients will be less than they had assumed, a hit of $1.8 billion. So it and a lot of other health insurers following this morning losses now nearing some 31% in the session. We also have some sell-side upgrades this morning, one of them being to Apple by Jefferies. Shares are up 1.3%. The key to the upgrade is China, saying that it looks like sales are going to be looking better for the quarter thanks to very targeted discounts. At the same time, though, the analysts there are still warning on things like falling behind on AI and the tariff disruption to Apple. The final upgrade comes from KeyBank to Cava, the fast casual Mediterranean restaurant, saying that it really is in its own league. It has its own category in terms of fast casual Mediterranean, that it apparently will do to Mediterranean food what Chipotle did to Mexican food. I'm not sure whether that's a good thing for the world, but they say that's a good thing for Cava. Shares up 2.6%, John.
Danny, you share your thoughts. Thank you. Appreciate it. Danny Berger with the latest there. Let's share Lisa's thoughts with you right now. Lisa, this bond market, not in the US, in the UK. We're looking at a 20 basis point move at the long end of the curve. Sterling's weaker, bad mix for the UK, that is.
Taking pain politically in the form of some sort of fiscal restraint doesn't do well politically. It does well in the bond market. When you raise questions about how much you are committed to those types of budgets, those types of plans, you see a fierce reaction, certainly in the UK. You haven't seen it as much in the United States, but it really goes to the credibility of the key people in place and the ability to cut spending in any kind of real way at a time of not that fast growth.
Policy volatility. Yeah. Once again. Questioning the credibility of the British government this morning in financial markets with bonds lower, yields higher and a pound weaker. Cable 136.39, negative on the day by 0.8%. That's the UK. Let's focus on the US. Let's get back to those job numbers. Is this going to be a test for Chairman Powell in the not too distant future? Numbers out just moments ago from ADP in the negative. Down, a big downside surprise on ADP, negative 33,000. The estimate was positive 98. With more, let's get Mike McKee for a whole lot more. Mike McKee on this, the data tomorrow, and the chairman of the Federal Reserve.
Well, I don't think we got a lot of additional news from Jay Powell yesterday. He basically repeated what he and others at the Fed have been saying for some time, that they need more information. And of course, next week we get the reciprocal tariffs. Then there are national security tariffs to come, et cetera. So they haven't got enough to go on in terms of deciding whether or not they can cut rates. Now, if we get a really bad payrolls number tomorrow, it will certainly raise questions in the markets, if not at the Fed. We're not expecting that. We are expecting a slowdown. 110,000 jobs is what the consensus forecast is at the moment, unless people incorporate this ADP into their forecasts. And we see 100,000 as the whisper number. Now, ADP private jobs minus 33,000 this month. The survey week for jobless claims was 246,000, which is basically where it had been for about 4 weeks before that. So no hints from there. But yesterday, the ISM manufacturing jobs number came in at 45, suggesting big job losses there. And that's not what ADP found. They found a gain in a significant gain in manufacturing jobs. So it does raise some questions about ADP. We'll see who turns out to be right. Now, you mentioned, Lisa, that this was the worst ADP number since March of 2023. That at that time, ADP reported a loss of 53,000 jobs. But non-farm payrolls were reported the next day at 236,000. Now, that sounds like a huge miss for ADP and a really bad job. But look, we now have March non-farm payrolls revised down to just 85,000. The Fed won't have any revisions. They'll have what the number is tomorrow. But it just goes to show you that ADP might have a hint in it, but maybe not immediately.
It's called the random number generator for a reason, Mike. Michael McKee, thank you, sir. More from Mike through today and tomorrow. ADP negative 33. Joining us now for more, Kathy Bostjancic of Nationwide. Kathy, got to get your thoughts on that ADP report. When people call you later and say, Kathy, negative 33, that sounds absolutely awful. What do you say back to them?
Yeah, good morning, John. Well, I would caveat, just as you have, that month to month ADP is not a good indicator of non-farm payrolls. Over time, though, these two series do move together. They capture the trends in the labor market. But I don't expect a negative print. And you never know, right? I mean, you're forecasting minor changes in a labor force that's 140 million. So certainly you could get a negative print, but most likely we see a slowdown in payroll growth. And we think that's not just, for tomorrow's number, but over the next couple months, we see this gradual slowdown. And you were talking about the churn. There's a lot of churn going on, a lot of things hitting the economy, tariffs, immigration changes, but it doesn't indicate to us that we're falling off a cliff.
And Kathy, just sit on the slowdown, the step down. We've gone from saying jobs growth is going to be something like 200K to jobs growth is going to be something like 150. And now a lot of economists coming on the program saying, get ready for 100, maybe get ready for 50 to 75. And then the conversation we have is, OK, is that a reflection of immigration or a weak economy? Kathy, which one is it?
It's both, I think. I think it's a reflection of both. And I think the tariffs and the uncertainty around that is really paralyzing businesses. You see that did come through in ADP, and you see that in all the anecdotal surveys to ISM and Beige Book, things like that, that businesses are just holding on right now. They're not really hiring new workers, they're not replacing them. But they're also not engaging in mass layoffs, and that I think that's a critical difference. If the economy is really hitting a hard stop, layoffs would increase. You don't see that in jobless claims, and we're not going to likely see that tomorrow. But just the slowing of hiring is critical and can slow down the pace. So I would agree that we're poised to, at some point get down to 50, 75,000. I think that's the low point, and we're looking for GDP growth to average about 1% in the second half of the year. So it's a meaningful slowdown, but not, again, you're not hitting a hard stop.
We got JOLTS yesterday, which completely flies in the face of the ADP report that we just got, to John's point about a random number generator. I feel like everything right now is a bit of a random number generator. How do you square the idea of a still robust job openings figure that came in much better than expected and a quits rate that went up, which is a good trend, meaning people feel like they have the capacity to quit and then get another job, with a negative ADP report and potentially really low payrolls report tomorrow?
It is hard to square those two. I mean, one thing I would say is the JOLTS lagged by a month, but more importantly, I think JOLTS is a bit of an outlier right now. It may be because survey responses are getting quite low there on that survey. But I think it does sort of balance. If people are really quite negative looking at ADP, it gives you a little bit of that balance of, again, labor markets slowing, the churn is happening, but we're not seeing companies get extremely pessimistic. They're just waiting and seeing, just like the Federal Reserve doesn't quite know what to make of the impact of tariffs on inflation versus growth. And I think companies are doing the same thing, and they're just in this holding pattern. I do think the peak uncertainty is behind us on tariffs. It does look like there's going to be some trade deals, some resolution. It's not going to be, uncertainty is not going to be removed completely, but I think the fact that going forward, it should lessen. That should help loosen things a little bit.
Just to add to the noise and the confusion, ISM manufacturing came out yesterday, and the employment component actually came in below where people expected. So if you thought the goods sector was somehow the one creating jobs, which we saw in the ADP number, that was called into question by the ISM manufacturing number. Have you ever seen such a time of messy numbers that don't lead to any obvious conclusions?
It ranks up there. It is quite messy. I would say that all of these measures we would use, sometimes you look at a 3-month moving average or trend. You can never, you can put all of these into your model for non-farm payrolls, but any given month you can have some divergence. And I think, that's what we're seeing here. And remember, ISM is a diffusion index. So I wait to see the non-farm payrolls. That's like the final arbiter for the month. But as John pointed out, and you've been talking about, there's also downward revision. So we need to watch those. They tend to be pro-cyclical. So my sense is, the labor market is slowing. You're seeing also, last month we saw discouraged workers increase. And that's been increasing over the last few months. So that's also a sign that, there is some weakening in the labor market. And I think the question is the degree of that. And I look for the establishment, the payroll data, to be the final, arbiter.
Kathy, remind me, what's your number for tomorrow? What do you expect?
We have 105,000, so not too far from consensus, or we're in between the consensus and whisper number, I guess, at this point. We could see the unemployment rate move a little higher. Remember, it was held down last time because people dropped out of labor force. That's that discouraged worker effect. That wasn't a great mix. So we could see the unemployment rate move a little bit higher.
Kathy, thank you. Kathy Bostjancic there of Nationwide. Ahead of payrolls tomorrow, the estimate in our survey as the Economist guesses come together. Stress guesses, educated guesses. Am I doing enough to dress that up?
You're doing a great job.
Keep digging. 110,000 is the estimate in our survey. The previous number, 139. Now, the following quote, just because I read it doesn't mean I'm endorsing it. This is from a Bloomberg subscriber. The following: rates are not rallying on ADP. Rates don't believe the story. Stocks are unchanged, but stocks are dumb. Now, you could probably guess they're in fixed income, but that's the view of the market right now.
Stocks are dumb, did they say?
You imagine that's going to be a rates trader, right?
Well, of course that's a rates trader, but I just, no one's responding to anything. I mean, if there's a little bit of a sell-off in stocks, you could say stocks are looking elsewhere. I mean,
diplomatically.
Yes,
okay.
okay.
When are you the one to turn to diplomacy?
I love bonds.
Say what you think.
I love bonds.
There you go.
Right now, the difficulty is, typically, it's a balance sheet point with bonds. You understand the input in, you understand the input out, you understand some sort of measure of risk. Now you don't. You don't understand because of the deficit and questions around inflation. So it becomes the same Rorschach test that stocks do. So it's getting less perfect in the math world, and it's frustrating.
The bond yield's getting dragged higher at the moment at the long end of the curve, up by 7 basis points. The epicenter for some of this, not actually down in Washington, D.C., seeing a sell-off in the gilt market as we test the credibility of the British government. Yields are much, much higher across the curve in the UK, particularly at the long end. With an update on that and a whole lot more with some of your top stories in your Bloomberg Brief, here is Yahira. Hey, Yahira.
Hi, John. We start with some local news. New York Port Authority is closed due to a multi-bus accident. Because of that, New Jersey Transit bus service traveling to and from Port Authority is being rerouted, and bus tickets and passes are being cross-honored by NJ Transit Rail and PATH. The New York Fire Department said 14 people are currently being treated for non-life-threatening injuries. Meanwhile, Wall Street banks boosting their dividends after passing this year's Fed stress tests. The annual review showing all examined banks would maintain enough capital to withstand a hypothetical economic downturn. The Fed made the stress test easier to pass by softening some requirements and plans to make further changes to reduce volatility. And Foxconn has asked hundreds of Chinese engineers and technicians to return home from its iPhone factories in India. Sources telling us here at Bloomberg that the move began 2 months ago and more than 300 workers have left. It marks a setback for Apple's manufacturing push in India. That's your Bloomberg Brief. John?
Yahira, thank you. It must be quiet on Wall Street this morning. I'm hearing from all of you. Get back to work. Barry Knapp says this. Remember my quote, bond traders are always negative because the best they can ever get is par.
Okay, that is just nasty. First of all, they get their money back, and also they have math, and also
you're their lawyer?
You start talking about potentially going out and buying at a discount, especially if there's a lot of fear elsewhere or belief in euphoria.
Barry's an equity guy, in case you didn't guess. All right. Up next on the programme, setting you up for the day ahead. Plus, we'll catch up with Tony Rodriguez of Nuveen on the potential impact of President Trump's tax bill on this bond market. Live from New York, this is Bloomberg. Equities negative by 0.1% on the S&P. On the Nasdaq, we're down by around about 1/3%. Some economic data behind us and a lot still ahead of us. As we count you down to the opening bell, your trading diary is shaping up as follows. On Thursday, U.S. trade balance and another round of jobless claims, plus the big one. It's payrolls Thursday. It's not payrolls Friday, ahead of the market holiday on Friday for the July 4th holiday. It is still a self-imposed deadline for the president's self-imposed deadline to pass his tax bill and his spending bill. And then a sneak peek of next week, another deadline, another self-imposed deadline. The president's tariff deadline is just around the corner. As that big, beautiful bill hits a bit of resistance in the House ahead of the Friday deadline, we need to get you an update. Tyler Kendall joins us now from Washington with more. Tyler, where are we? How many holdouts are there? And what is the lesson from the Senate for some of the individuals in the House maybe thinking of standing up and saying, I don't like this?
Yeah. Hey, John. Well, if we look at the holdouts that we had seen in the Senate, perhaps some of the most vocal were those fiscal hawks like Ron Johnson and Rick Scott. Ultimately, they ended up voting for this bill, which could signal to their House counterparts, those members in the House Freedom Caucus, that at the moment there doesn't really seem to be momentum to make those sort of changes that would require this bill to be kicked back to the Senate. I will say that we did hear from at least one Senator, Lisa Murkowski, yesterday, who voted for the bill, but did say that she would welcome if the House ultimately put this into conference and made additional changes. Now, we could get some sort of indication here, actually, within the next 10 minutes on how this day could develop, because at 9 a.m. Eastern, the House is going to convene, and they're going to debate on voting on what's known as the rule. Now, this is not the vote on final passage. It's a procedural motion, but I pointed out because if the rule fails, that could spell big trouble for Republicans, because essentially it would mean that some of these House lawmakers are digging in and trying to get more compromises. If the rule passes, then they can proceed to debate and ultimately later on today, that final vote. That's what we're going to be looking for, because it could really shape the trajectory of this bill in the House. John, House Speaker Mike Johnson, as you well know, can only afford to lose 3 votes. And at the moment, we're seeing reports that President Trump could be meeting with some of those holdouts, including members of the House Freedom Caucus.
Tyler Kendall with the latest down in Washington. Tyler, thank you. Here's the view on Wall Street at the moment. Here's a quote from Tony Rodriguez of Nuveen. Congress has moved forward with its budget bill, with the House's proposal including more front-loaded easing than previously expected. This has put upward pressure on yields. Tony joins us now for more. Tony, good morning.
Good morning.
Felt like the bond market was ignoring this for quite a while. Is it paying attention again?
Well, we think it will. Right now, it's battling between the risk of some negative data, right? We saw it with the ADP report, for example. So we still think fixed income is going to be a good hedge if we get that downturn. So there's some buying kind of for that purpose. But longer term, we think it's the fiscal deficits, which are going to continue to push the term premium up. And you should see a steep curve.
Is that a US story or a global one? Because also this morning, we're looking at yields in the UK rise by double digits, 15 basis point move on 10s, on 30s close to 20. Is this a global story?
Completely. We've seen term premium rise in almost all developed markets, right, over the last, call it 6 to 9 months. So we think that's going to continue. We see Germany, we see UK, we see the US, all with fiscal expansion. So the bond market's going to have a lot of supply to digest. And we think that's going to mean kind of some difficulty. We don't expect kind of these 20, 30 basis point moves to happen necessarily in the U.S., like we're seeing right now in the U.K. But we do think you could see some upward pressure unless you start to see weakness in the economy.
The market hasn't been clear on exactly whether it would accept rate cuts in the U.S. in response to weakening data as something that isn't necessarily a negative for longer-term inflation expectations. It won't necessarily cause inflation to surge. Do you push back against that? Do you think that rate cuts in this type of environment will just fuel the long end and lead yields that much higher?
I think right now they would, because the data has been so resilient. So I think that the cuts really can't happen unless you get actual hard data that begins to fall in line with the soft data that we've seen, where there's been quite a bit of weakness. So I think that the Fed being patient until they're more confident you'll see that hard data, that's what's going to drive them. So the employment report tomorrow, right? If we see, say, a 0.2 increase, if we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates. And those cuts wouldn't necessarily be viewed as inflationary because they're in response to the weaker hard data.
I just wonder at what point do we get weaker hard data and actually higher long-term yields, because essentially this would increase the deficit, would it not? And it would actually challenge any kind of fiscal response to any kind of downturn. And I talk about that on a global stage. Isn't that the case?
Yeah, absolutely. We think a steeper curve is going to be the story. I think it'll be, if we get that weakness, I think it'll be around Fed cuts. We think that we're going to get 2 cuts either way, because right now there is enough of a slowdown. We're thinking 1% growth. It's if you see a recessionary environment where you really get into trouble around the Fed having to respond, but there being no fiscal capacity to do anything. So that's when you really, I think, will get a much steeper curve with more aggressive front-end drops. But we don't think that means 30-year at 6%, 10-year at 6%. We just think you'll see 10-year at 4.5%, 30-year above 5%. So higher than where we are today if you get that kind of scenario. But right now, our view is that you're not going to get the recession, so you won't get very aggressive cuts. You'll get some modest cuts. That leaves the long end of the curve kind of right now around maybe fair value, So 4.25 is what we thought for year end. So we're kind of ahead of the game right now. So we're not expecting any further drop from here for the balance of the year.
That is the ultimate fear, that bonds don't do what they're meant to do. And that for me has always been the difference between what is DM and what is EM. I've always considered EM anything whereby you get bad news and the bonds sell off. In DM, when you get bad news, the bonds rally. And if we're talking about, if you're worried about deficits now, wait until a recession. If we're talking about that, hitting bonds the wrong way, that's a world we're not used to in developed markets.
And that's a world that the United Kingdom right now is flirting with. And it raises the question about whether this is the road to travel, especially if you have a budget that is dependent on growth. What happens if you don't get that to the deficit and then the response in the bond market?
Too gloomy. OK, let me finish on this quote
You keep
here.
saying it's not going to be gloomy.
I wish I could actually say who this was from, but I can't. OK, here's the quote. Stock investors ignore data. This is why they keep piling into stocks with valuations in the top 10 decile, while economic outlook is not great at all. The bond guys are all as seen in the UK. It's another bond guy out there, all right? There is virtually no stimulus in the BBB. It is a path to a BBB rating. That's the line from bond investors this morning.
I got this really sophisticated response. Stock traders are morons.
Is that the message you got?
Yeah.
OK. So fixed income's bored this morning, right? And that's why they're messaging us.
Evidently,
Okay.
yeah. Sorry, I don't endorse that.
Defended stock investors.
I don't endorse that.
All right. From New York City, I've got to go. We're up against the break. This is Bloomberg.